So, a big welcome on behalf of myself, Fiona Quinlan Wells, to this half day of training on applying the IFRS Sustainability Disclosure Standards. This program is truly a collaborative effort driven by that demand we're seeing in the market for more capacity building to support the adoption of the IFRS S1 and S2 standards. So, a big thank you, firstly, to our partners on this program, to the IFRS Foundation, to the IFC, and also Bloomberg Philanthropies and the Swiss government as well for their support. And of course, a big thank you to you as participants for taking the time to join us in the training session today. We're also very grateful to our hosts at the Muscat Stock Exchange for helping us to coordinate and host today's webinar and bringing us all together. So a big thank you to our colleagues at the Muscat Exchange who've made today possible. So with that, we'll move into getting started on the content. So a few little housekeeping points. Firstly, to talk about in terms of how we'll work the session today and what we're going to be covering. So firstly, you'll notice that as participants, you're muted, but that really doesn't mean that we don't want you to interact with us in the session. So it's great to see a number of you already sharing your comments in the chat. Feel free to continue to use the chat throughout the session to make any general comments. If you have particular questions for us, it's great if you can please make sure to put questions in the Q&A box. That will just allow us to track and directly respond to the questions and make sure that they don't get lost in the chat. So please make sure to use that Q&A box as well. And so our format for today is a live 3.5 hour session together. We'll take a short break in the middle of that as well, don't worry. And we'll also have the option of a follow-on homework exercise that you can complete as well if you'd like to. As I've already mentioned, there'll be that live opportunity to ask your questions during our session today in the Q&A. So please make sure you do make the most of that. I'll introduce everyone shortly, but we've got a number of experts here with us today able to help you on your questions. So be sure to ask anything that you're unsure about. We'd also really encourage and love to have your participation in today's session. So we're going to be using a number of interactive tools today, including the Zoom polling feature and also a tool called Mentimeter. So we'll explain more about that shortly, but it'll be great to have your participation in those exercises as well. It's a really important part of the learning journey, of course, for us to start to reflect on and apply what we're learning in the training. And finally, if you join us for our full workshop today, you'll be able to receive a completion certificate for taking part. So to get your certificate, you'll need to fill out the feedback survey, and we're going to share that with you at the end of the training. So be sure to have a look at that towards the end of the session. And so just to say who's going to be delivering the training today. So as I've mentioned, I'm Fiona, and I'm also joined by my colleague, Lois Guthrie from the SSE team. Hi, Lois. And then alongside us as well, we're very pleased to be joined by our co-facilitators from the IFRS Foundation. So firstly, we have Robert Swiatowski, who is the Partnership Manager for Capacity Building at the IFRS. Hi, Robert. And also Rebecca Wilkinson-Blanc, who's the Director of Regional Corporate Engagement as well. So big thank you both for being here with us as well. And so from our training today, we've got 2 or 3 key learning objectives. So firstly, we'd like to help you to understand the ISSB standards. So understanding what they are and how they came to exist. Secondly, we'd like to help you to understand how you can use the ISSB standards. So what content disclosures you need to provide and how those align with existing reporting requirements as well. And finally, we'd like to help you to identify the steps that you can take to develop a disclosure plan to apply the ISSB standards. So when we put all of this together, we've broken it down into a step-by-step structure for our training that can help us to walk through those different areas. So we'll kind of show you this wheel diagram a number of times during the training, and you can just keep that in mind to get a sense of where we are in the structure of our course. So our first module that we'll get started with is called Prepare. So that's all around building on existing knowledge that we might have of sustainability reporting and how the landscape of disclosure standards came to evolve to reach the global baseline of the ISSB standards. In our align module, we're going to then be thinking about how to set the direction for our reporting. So thinking about how to apply and use the standards and any additional disclosures that you may also need to add to meet different requirements. In implement, we're then going to really be getting into practices and systems. So this is all about how to identify, evaluate, and integrate sustainability related risks and opportunities into your business and into your disclosures. And then we'll finish off in our final module, communicate. So thinking about how to prepare our information for public disclosure in its final format and how to do that at the right time and in an efficient way that gives confidence to your stakeholders. And so to help us meet those learning objectives and that set of modules there, we've broken our time down across the session into the agenda that you'll see there. So we'll take a break, as I said, in the middle of the session. We do know it's a long time to be concentrating for online. And then towards the end, we'll wrap up with some time for some additional resources to take away. But we'll be broadly following that four module structure as we move through our training today. And then an important point to highlight, and I can see this has already come up in the chat, I think, is just to let you know that all of the training materials that we're going to be using today are available already for you from the SSE webpage. So Lois has shared that link in the chat, and we'll share that again a number of times. But on the page for today's session where you would have signed up, you'll be able to find at the bottom the resources section. And that will include the slide presentation we're using today and also the homework assignment. After the training, we're going to be adding the recording of our training to that page as well. So we'll share links in the chat to you today to a number of resources, but please keep in mind that those resources are also available in this slide presentation. And as I've mentioned, one optional part of the course is to complete the homework assignment after the training. So the focus of the homework assignment is all around developing that disclosure plan for your own organisation to put into practice what you've learned and hopefully help you to take this forward. So the homework isn't mandatory to complete and there's no need to submit this to us. But you can find the homework at the same page that Lois has just linked to in the chat. And we hope that can help you. We're going to use the exercises that we do at the end of each module today to start thinking about the same areas as would fit into that disclosure plan for the homework. But we'll also be sharing that in the homework as well. I can see we've had a couple of people comment they're not able to hear. I don't think this is a wider issue, hopefully. But if you are having some audio problems, I'd recommend maybe just trying to rejoin the session or perhaps trying on a different device. I appreciate you might not be able to hear me giving that information, but we hope you'll be able to find a way to get your audio settings to work. Great, thanks for confirming you're able to hear, Mohammed. So also we'd like to mention the SSE toolkit of resources that is available to you to support your activities on this topic. So we've got the model guidance that we've developed on sustainability related financial disclosures, which follows the same 4-unit structure that we're talking about in the training today, but gives you more detail and additional resources on all of those areas. You can see a number of other parts of the toolkit there as well. But one that I'd like to highlight that we've just released is an FAQ, a frequently asked questions publication on this training program. So we've delivered this training now, I think, to close to 24,000 participants. And obviously, we've had lots of different questions over that time. And so we've developed an FAQ database covering the key questions that come up here. So we'd recommend checking that out, which is part of the toolkit you'll see mentioned there as well. Okay, so to get us started now, it'd be great to get a sense of kind of why you're joining us here today in the training and how much maybe you might already know about these topics. So we're going to use a tool called Mentimeter to do that. So I will share the screen to Menti now, and if I could ask Lois to please share that link in the chat as well for everyone to access Menti, that would be great. So you should be able to see my screen now. Thanks for the joining link there, Lois. And just to mention as well, you can also join us by using that QR code that you'll see on the side of the screen currently. Or also, finally, if you go to menti.com And if you enter that 8 number code you can see on the right-hand side and at the top there, you can also get in. So probably the easiest one is the QR code or that link that Lois has just shared in the chat. But once you're in Menti, it'd be great if you could just share with us in your own words, maybe why you've joined us here today in the training, maybe a particular topic you're interested in, maybe a particular driver for why you wanted to come to this session, and we'll be interested to see what those are for you. Okay, so I see knowledge, learning, upskilling, requirements. So maybe some people might have a more of a mandatory reason to do this already, perhaps. So good to be aware of that. And then we're also seeing being prepared. So maybe you're trying to get ahead of regulatory needs, exploring, inquisitive, updates, learning, understanding the reporting. So, yeah, lots of kind of general senses of wanting to be prepared for these requirements to understand them better. So, we hopefully will definitely be able to help you with that today. And then our second question, just to get a view of what your starting point is here, is just to get a sense of how comfortable you are currently with each of these different tasks. So you can use the sliding scale in Menti to let us know from the left-hand side, maybe you're completely new to these topics and not familiar at all, to the right-hand side, where maybe you already know this quite well and are very comfortable on these areas, letting us know how you feel about these 3 different aspects. So, explaining to your team members what the ISSB is, on using the standards, and on developing a sustainability reporting strategy. So I'll give you all a few more minutes to have a think about that. Let's have a look. I think about half of you have joined us in Menti so far. So it would be great to have a few more of you joining Menti as well, because we're going to use it a number of times in the session. So once you've joined us in Menti, you'll have that link available to you to do the exercises later on in the session as well. So encourage you to join us in Menti if you haven't done already. It looks like overall we're probably feeling on the lower end of comfort at the moment, somewhere between the sort of midpoint and the bottom. So that's no problem at all. It looks like maybe we're a little bit more confident at the moment on the sustainability reporting strategy. So good to know some of you perhaps already have some broader sustainability reporting experience to draw on here, because that's likely to be helpful for you for sure. But good to get a sense of that current understanding. So thanks for sharing, everyone. Okay, let me reshare the slide presentation now. Okay, so with that kind of introductory segment, we're now going to dive into the first part of our training. But before we do, I have a quick disclaimer that I'd like to share with you at the start of the session. This is really just to be clear about how we're going to be using examples of company reports in today's training. These are really simply here to add some inspiration and colour to what we're talking about, because we know, of course, sometimes seeing a practical example can really help us to understand what we're talking about. However, we'd like to clarify that any examples that we share shouldn't be seen as the best or the right way to approach this necessarily, because, of course, each company is unique and you need to do this in the way that best suits your own circumstances. Okay, so with that established, let's get started now on our first module, Prepare, which, as I've said already, is all around building a solid foundation of knowledge to move forward on and thinking about how the standards from the ISSB are built on existing frameworks and standards as well. So there's 3 key areas that we're going to cover in this first module. So firstly, in purpose, we'll think about the case and the purpose for sustainability reporting, including the market and the business case. We're then going to move into landscape, and that's where we'll look at how the reporting landscape has evolved and including how it's becoming simplified. And then at the end, we'll finish with the global baseline. So that's looking at the core concepts and requirements in IFRS S1 and S2 that set that global baseline. So to get us started on that, we're going to begin with purpose. So understanding firstly what some of the drivers are that might be causing an increased uptake and focus on sustainability reporting. And so to get us started with that, I'm going to launch our first poll question for you now, because We'd love to get a sense really of what your drivers are for focusing on this topic. Maybe you're already disclosing information, or maybe you're just starting to think about this topic. So you can select as many options here as are right for you, but let us know what your reasons are for disclosing sustainability related information. Maybe you have other reasons outside of those that we've suggested here, so feel free to share those in the chat with us as well. And maybe also you're not reporting yet, no problem, of course, if that's the case. It's good to get a sense from our side as to whether that's the situation for some of you. Okay, I'll give you a few more seconds to answer the poll before we have a look at those results together. Okay, maybe just a few more. Okay, let's end the poll there and we'll have a look at the results. So I saw someone has shared in the chat as well that transparency and pursuing a career in this area are their reasons as well. So that's interesting to know from those two participants. Thanks for sharing. But looks like overall regulatory requirements is definitely coming out as the top reason here. But investor interest is definitely quite a strong second by the looks of it for many of you. And a fair number of you also looking to share your own organization's objectives through this approach. So thanks for sharing that with us. It's good to get a sense. I think that is quite a common picture that we're really seeing regulation and that investor interest being key drivers here. But good to see a number of you also recognizing the benefits internally for doing this as well, which we're going to cover off more shortly. But starting to have a look at a few of those drivers. So I know a number of you there did mention that investor interest was one of your drivers there. So we'll just start by looking at that perspective because it's a really important one when we're talking about these particular standards. So the starting point we're just showing you here is the number of signatories to the Principles for Responsible Investment. And I think this is a useful measure to just get a sense of how many investors are really focusing on this topic and are starting to implement it within their investment strategies. And so we'll see now that we've got over 5,000 signatories to these principles, representing more than 128 trillion US dollars in assets under management. So clearly a significant proportion of the investment community. And so, what is it that's really driving that focus from investors on sustainability? Well, I think what we really want to highlight here is that the key driver behind this demand is really the potential financial effects of sustainability related issues. And that growing recognition that for companies, this is a highly relevant thing to consider for long-term value creation and strategic resilience. And so the data we're seeing on the screen at the moment is coming from a study of institutional investors that was conducted by HSBC. And in this study, they found that the top driver for those investors included in the study to incorporate climate and environmental issues into their investment strategies was the perceived impact of these factors on long-term performance. And so, really just highlighting that this is not a nice to have or some sort of impact investing approach for many investors, but really increasingly a core part of how they understand a company's performance. And so you can take a look at this study in the handout if you'd like to have a look at that in more detail. But before we move on, we'll just kind of talk about a few key terms that we're starting to touch on there already. And so the first of those is financial performance. So it's important to remember today that we're talking about disclosing financially material sustainability related information. And so we're going to talk about that in more depth later in the workshop and what we mean by material. But we want to be clear from the outset about the sorts of financial effects that investors will be looking to have more information on here. So we'll start firstly with effects on a company's performance. And we often see that in the statement of profit or loss, which shows income or revenue and expenditure. Sustainability related risks and opportunities may have a financial effect by changing the revenue mix or total revenue of a company. For example, if demand for its products and services change, or perhaps its production capacity might be disrupted, as examples. And we could also see changes in expenditures. If, for example, operating costs were to increase due to energy prices, or perhaps there was a need to invest more in research and development to capitalize on sustainability related opportunities, or maybe other costs associated with deploying new practices. And you'll probably also hear us talk today about effects on a company's financial position. So we'll also take a quick look now at what that means. And so we often see a company's financial position reflected on their balance sheet or statement of financial position. And here, for example, a company could experience changes to certain assets or liabilities due to climate or sustainability issues. So we could see changes to portfolio value, or we might even see write-offs of certain assets that are damaged or need to be repriced. And another financial effect that should be documented is potential changes to financing and the cost of capital as well. So that could include, for example, equity valuations that may be impacted by climate risks, as well as making use of new financing structures such as green bonds or social bonds as well. And so before we move into our next unit of the module, I just wanted to flag two important concepts relating to risks and opportunities, which are really essential to our understanding of them and our disclosures. And so before we jump in, it's worth noting that the ISSB standards are designed to help companies identify and communicate their own specific sustainability related risks and opportunities. But we'll have a look first at this global picture to help us understand these 2 points. So the data you can see here, you might be familiar with, is coming from the Global Risk Perception Survey, which is carried out annually by the World Economic Forum. And this really shows how risks evolve over time. So those risks that might be most kind of front of mind on a short-term horizon could be very different to those that pose the most significant risk over a longer-term time frame. And so that's a really important thing to keep in mind for our disclosures. For two reasons, really. Firstly, because we should, of course, be thinking about and disclosing those longer term risks. But also, if we're going to be taking action now to prepare for a risk that might occur on a longer term horizon, it might be that we have to take actions or make financial decisions today to mitigate that risk. And actually, what that could mean is that the financial effects of that risk could start to occur much sooner than when we're predicting the risk itself would materialize. So that's something that's important to keep in mind for our training today, that thinking about time horizons is really quite critical here. And then a final concept about risk that we think it's really useful to flag at the outset is the interconnectivity between sustainability risk types. So this is another visual coming from that World Economic Forum report, and it really just shows the many different connections that exist across social, environmental, political, etc. risk types. So whilst people could think of the two ISSB standards S1 and S2 as separate topics, however, you can really see from this slide, many sustainability related risks and opportunities are very interconnected. And therefore, if we separate out one topic or theme from a reporting perspective, of course, that doesn't remove those connections. And what we have to try to do in our disclosures is to consider the whole and how those things fit together strategically. And in fact, if we look at IFRS S1, which we'll go into shortly, that sets out the conceptual foundations for ISSB disclosure. This does include particular requirements on connected information. And so there really is that aim to give investors a holistic picture of a company's sustainability related risks and opportunities. Okay, so that brings us to the end of our first unit. So I'll pass over to Lois now, who'll get us started on landscape.
Yes, thank you very much, Fiona. We have now covered why ISSB or IFRS sustainability disclosure standards are important. And now we're going to look at how the standards have been developed. But before we do that, we invite you to participate in this Zoom poll. which asks what standards or frameworks are you currently using to disclose sustainability information? Are you already using IFRS S1 and S2, the two standards we'll be talking about today? Are you using the Global Reporting Initiative standards, the Integrated Reporting Framework, the Sustainability Accounting Standards Board's standards, the recommendations of the Task Force on Climate-Related Financial Disclosure, the European Sustainability Reporting Standards, others or none? Let us know. I'll share with you the results so far. And yes, we do have some people on this webinar already using IFRS S1 and S2, so that's great to hear. The majority of participants, though, are using the standards of the Global Reporting Initiative. Few people using Sustainability Accounting Standards Board, some using none at all yet. So mainly we have GRI and IFRS, so that's good to hear. Thank you. Those of you using IFRS standards, please do let us know when we come to examples and things, any feedback you have about your practical use of the standards. Let us know in the chat or in the Q&A. So we're going to move on now to look at the structure of the IFRS Foundation, which is the organisation that has developed these standards. Well, the Foundation is a not-for-profit public interest organisation established to develop high-quality, understandable, enforceable and globally accepted accounting and sustainability disclosure standards. The Foundation has two independent standard-setting bodies you see at the bottom of the screen. These are the International Accounting Standards Board, or IASB, formed in 2001, and their standards on accounting are in place in over 140 jurisdictions around the world. The sister organisation, the International Sustainability Standards Board, whose work we're talking about today, was formed in 2021 and it released its first standards, IFRS S1 and S2, in 2023, following strong market demand for its establishment. Because the two standard-setting boards are both within the IFRS Foundation, they work very closely together and can ensure that their standards complement each other. The boards are governed by trustees who are in turn accountable to a monitoring board of public authorities. So let's have a look at how the standards came to be developed. You probably recognize, certainly you'll recognize GRI, you'll recognize some of the logos on this screen. And these are the logos of organizations that have contributed to the evolution of sustainability reporting. Although some people have seen this as a confusing picture, actually these organizations have a lot in common. And the one message that we would want you to take from this slide is that this shows a picture of harmonization and simplification. And most of the organizations shown here focus on investor needs for sustainability information, as does GRI, but they also elicit information to support a broader range of stakeholder information needs. Now, the arrows show us that some of these organisations are working very closely with or have been incorporated into the IFRS Foundation. So the three organisations at the bottom of the screen, CDSB, the Integrated Reporting Council, and the Sustainability Accounting Standards Board, those organisations have been consolidated into the IFRS Foundation. The work of the Task Force on Climate-Related Financial Disclosures and the Transition Plan Task Force, their work has also been incorporated into and is now the responsibility of the ISSB. CDP has aligned their climate questionnaire with IFRS S2 on climate and worked very closely with the IFRS Foundation to align their questions. And GRI is also working very closely with the ISSB to ensure that they can jointly identify and align common disclosures. So, as I said, a picture of integration, consolidation, harmonization, and simplification. So let's, given that there are still different organizations, let's think about what are the differences between reporting standards and frameworks that still exist. Are the differences because the organizations have different reporting objectives? Or because the scope of their work is different? Some focus on different subjects and some focus on different audiences. Is it because they use different definitions, different wording, they have a different materiality focus, or is there something else that requires the standards to be different in some respects? Just giving you a moment to think about that. Yes, let's share the results now. Yes. I mean, really, all of these answers are correct. So I would say that those of you that have said reporting objectives, scope, and materiality focus, that's the majority of you. So well done. Yes, I would say they are the main reasons, but actually, all of these differences apply. Um, it just depends on what the organisations are seeking to achieve and for which organisation and what is the scope and focus of their work. So the differences can be explained according to these different reasons. Let's have a look now at the way in which the IFRS Foundation and the ISSB used the recommendations of the Task Force on Climate-Related Financial Disclosures. Now, I could see from the Zoom that not many of you were using the TCFD's recommendations, so I'll be brief here. Just to say, as I said before, the work of the TCFD has been taken over by the IFRS Foundation, who has assumed responsibility for monitoring climate disclosure progress. What they've done at the ISSB is that they've incorporated the TCFD recommendations into IFRS S2, but there are some differences between TCFD and S2 that you would need to be aware of if you'd been using TCFD. But briefly, they are differences of wording, but wording is different but intended to capture the same information as the TCFD. Sometimes S2 requires more detailed information, perhaps about the use of carbon credits to satisfy carbon reduction targets, or S2 requires some additional requirements and guidance, and an example here would be the use of sector-specific topics and metrics, which we're going to come on to discuss later. So the objective of the ISSB was to set a global baseline for sustainability-related financial information that would enable comparable and consistent sustainability disclosures across global capital markets. And the foundation is working with jurisdictions around the world and other stakeholders to achieve this. So the standards set the common language, but of course, the ISSB recognizes that regulators and stock exchanges, and I can see some of you have mentioned local stock exchange standards in the chat, they may have additional or jurisdiction-specific requirements that are building blocks, as they're described, that can be added to the global baseline. This means that in addition to the global baseline set by the ISSB standards, additional disclosures can be required by jurisdictions and stock exchanges and others, as long as that information is presented in a way that does not obscure the disclosures required by the ISSB. So these building blocks could involve disclosures going beyond the remit of the ISSB standards, so they could include the sort of information requested in in the GRI standards or jurisdiction-specific information relevant to investors. So this building block approach means that we have the globally consistent baseline of disclosures for capital markets whilst allowing additional information based on standards like the GRI standards to be reported. It reduces the need for duplication and simplifies the reporting landscape. There's been global backing for this approach for the global standard, represented by the ISSB standards. IOSCO, the International Organization for Securities Commissions, has endorsed the ISSB standards and asked its members, 130 members, to consider how they can incorporate the ISSB standards into their regulatory frameworks. The foundation engages with other stakeholders to assist on adoption. For example, the International Auditing and Assurance Standards Board, who's developed a new assurance standard for sustainability disclosure, which is ISSA 5000. You can see the link there. The Foundation has a regulatory implementation program to support jurisdictions with planning and preparation for voluntary and mandatory adoption of the ISSB standards. And the Foundation is also working to support voluntary disclosure, including through initiatives like this webinar you're attending today. So we're now going to turn to look at the standards in more detail themselves, and Robert is going to take us through that to start with.
Perfect. Yes, thank you very much, Lois. Hello, everyone. And indeed, we'll be now talking. We're moving to the next section of this training and be providing you an overview of IFRS S1 and S2. So far we covered the business case and the market case for sustainability reporting, and the evolution and how the different standards comes together and how they're being simplified and rationalized. So now it's time to cover S1 and S2. Before we get into the details of both standards, let's take some time to note about some key terms that should be understood. So you will then find a definition of those terms in the handout, but let's then go briefly through them right now. So first of all, we'll be saying the phrase sustainability related financial information a lot today. So what does it mean? This is the information about broad set of issues, including climate, nature, biodiversity, but as well human and or social and other aspects. And now, sustainability related financial information is also information about companies' sustainability related risks and opportunities that is useful to investors in making decisions about providing to the company. So this distinction here about this usefulness of the information to the investors is really important. Further, sustainability related risks and opportunities are those that could be reasonably expected to affect companies' cash flows, access to finance, or cost of capital. So in other terms, could affect the company's prospects. So how to understand what is useful to investors, or what information is useful to investors? It's that information which then would then inform about the access to the cash flows, the access to the finance or cost of capital, which affect the cost of capital. So further, we will also often refer to general purpose financial reports, which includes a company's financial statements and management commentary. You may know this as a management report, management review, or management discussion and analysis or strategic report. And some regulators require specific disclosures in certain parts of general purpose financial reports. So we'll then use this generic term throughout. So here we just then summarize some key points of each term, but please refer to S1 for the full definitions of each of those phrases. Okay, so we covered this foundational terms, and then let's see how the S1 and S2 are structured. And we'll be now discussing those core content areas. So, as mentioned before, anyone familiar with TCFD will recognize the same four core pillars or content areas for the ASB standards as well. And these are governance, strategy, risk management, and metrics and targets. For each core content area, there are a set of key disclosures to be addressed, and the standards provide very detailed guidance on these requirements. We'll then discuss each of the four core content areas today, and I encourage you to download the standards as your part of the homework assignment. Okay, then moving to S1 and the general requirements standards. So to start, to all the preparers today listening, let me start by saying don't be afraid. There's a lot to understand, but you might be surprised that you are already familiar with lots of details here. To all the accountants listening then today, you've been also relieved to see that many of the conceptual foundations developed by IASB, the accounting body, are also present in ISSB standards. So to introduce you S1, let's give it the full title. The full title of the S1 standards is General Requirements for Disclosure of Sustainability-Related Financial Information. So this suggests, S1 sets out general requirements for the content and presentation of material information about sustainability-related risks and opportunities. And again, if you know TCFD, you will see the same architecture applied throughout the standards. Important to note here that for matters other than climate, S1 asks preparers to refer and consider the applicability of the SASB standards and other sources of further guidance to identify risks and opportunities and identify material information about them. The SASB standards are organized by industry, enabling a company to identify disclosure topics and metrics applicable to its business model and operations. And finally, the standards can be used in conjunction with any accounting requirements, which apply to any location you might be relevant. Right, so that's the overview of the S1. Let's move to the S2. So, as mentioned before, the scope of S1 is all sustainability-related risks and opportunities. And for S2, in that case, focuses on climate disclosures and building again on the same foundation of S1. So again, it incorporates the structured of the recommendation of TCFD. It also sets out requirements for a company to disclose material information about its climate-related risks and opportunities, and it requires the disclosure of both cross-industry and industry-specific information. So in terms of climate risks, this includes both physical and transition risk, which will come back later. Then also includes as to specific climate-related disclosures related to scenario analysis and greenhouse gas emissions. And again, preparers must refer to and consider the applicability of the industry-based guidance on implementing S2, such as SASB standards. And as we discussed before, these are organized by industry, enabling a company, in this case, to identify climate-related disclosures and topics, disclosure topics and metrics applicable to its model and operations. All right, and then how they relate to each other? How we see the S1 and S2 together? S1 and S2 are not standalone standards. They are a package and must be applied together. So even if a company is reporting only on climate-related risks and opportunities, the company must comply with both S1 and S2. This is because S1 sets out general requirements or parameters for the type of information that needs to be provided in order to be decision useful for investors. Also, as one explains the concept of materiality and how companies identify material sustainability related information. So let's now move to this conceptual foundations. These are foundations which underpin the ISB standards. So this might be new to anybody who is not familiar with without accounting background. So it's important to note here that these concepts help us to understand how best to disclose information in order to meet the requirements of the ISB standards. So first of all, the company must fairly present a complete set of related risks and opportunities. And that fair presentation also requires to be faithfully represented. So to achieve this, companies shall provide a complete, neutral, and accurate depiction of sustainability-related risks and opportunities. Further, then the notion of reporting entity requires the organizational boundary for sustainability-related financial disclosure and financial statements to be the same. And the third concept here is connected information. We saw earlier when Fiona explained how different risks are often interconnected. So the ASB standards require companies to clearly identify key connections, such as those between risks and opportunities, connection between connection between disclosures in the four content areas we mentioned, and also the connections between sustainability-related financial disclosures and the main financial statements. And here we'll have an example how that can be applied in real life, which will be presented by Lois. Over to you, Lois.
Thank you, Robert. And just to remind everybody, because this is our first example, let's remember what Fiona said at the beginning of the presentation. We present the examples today to illustrate certain practices, to inspire you, but these are not intended to represent best practice. They're just intended to show how some companies approach the concepts that we're talking about today. So this example is from a company called BHP, which is a global mining company, and it is an example to illustrate connections, and in this case between the company's decarbonisation strategy, its business strategy, its financial results, and other processes. So what do we see being connected here? Well, the first paragraph tells us that climate risk assessments and climate scenario analysis are integrated into the company's business strategy and treated as a sensitivity in the company's capital allocation process. So there we see connections and alignment between how the company makes decisions about how to allocate capital and their business strategy and how to adapt to a rapidly decarbonising global economy. In the second paragraph, they tell us that some assessments are still in progress, so they're being transparent about that. They're undertaking studies to assess the effect of future physical climate-related risks on the company's operations, productivities, and costs. And those results will be used to inform and therefore connect with the company's risk profile, corporate planning, controls, and adaptation measures. The light grey text shows us connections to further information about how the company considers the impact of climate-related risks on their operational activities, their greenhouse gas emissions across the value chain, their financial statements, and the production, revenue, and expenditure. So it's a short extract, but it gives us that sense that the company is not regarding climate-related risk as something separate, but they're connecting decisions and information about climate risk assessment and climate scenario analysis with their business strategy, corporate risk, planning processes, capital alignment, and so on. So let's hand back to Robert now to take us through a Zoom poll.
Right, yeah, thank you very much, Lois. Indeed, we're going to have a Zoom poll, and the question will be what we just discussed. What information should be considered for connected information? So please select here all which answers which apply. So in the sense of the S1 and S2 standards, what connections are then expected to be achieved? Connection between the four core content areas, connection between sustainability-related financial disclosures and financial statements, and connection between related risks and opportunities. I'll give you a moment to think about it and answer this question. And it looks like indeed you guys got it right. So in order to meet the requirements of the S1 and S2, you should you should apply connections and use the connection between all the elements listed here. So answer A, B, and C are the ones you should select to answer this question. All right, thank you very much. And then we'll be moving to the next section of this training and talking a little bit more about materiality. So the standards are built on the concept of materiality as defined by the IFRS Foundation. We are going to discuss this also more in detail later, but just to highlight at this time that we'll be referring to the material information today, which is information that, if omitted, misstated, or obscured, could reasonably be expected to affect investor decision making. So this is the definition of the materiality you should have in mind for the purpose of today's training. So now closing this section, we'll talk about some additional guidance. So doing the ISSB consultation on exposure drafts, one of the key feedback topics was the importance of supporting preparers, and particularly those in limited resources and those in emerging markets. So in order to address these needs, in addition to standards and application guidance published in 2023, a number of educational resources were also published since then, and others have followed, including the IFRS Knowledge Hub. We are also in the process of gathering examples and cases from our partners. The SASB standards were also used to create industry-based guidance and accompanying S2, which we also been mentioning before. And finally, the FSA credential was also updated with more updates planned to come. I should also note here that that IFRS Foundation Capacity Building Program launched at COP27 is a key part of support for the preparers, and this training today from SSC is one of the most important deliverables. So now we're moving to the next Zoom poll, and that might be a little bit more tricky. And it's designed to test a really important principle in S1 and S2. How to approach a disclosure topic where the IFS has not yet issued a topic-specific standard. And then we're going to use the example of water here. So let's see what you think, what the right responses are here. So the question is, you assume that water is the vital input in your business, but as for now, the ISB standards do not have a specific standards on water. What shall you do? And I have four options here. You should not disclose anything about the water. B, you should consult the sources of guidance listed by ISSB. You may engage with a consultancy to help, or D, copy your competitors' reporting. So I'll give you some time to think about it. What would be the right course of action in this case? I see it's almost half of you took part in this poll. So thank you for this. Yes, and you are right. The right way to proceed here will be to consult the sources of guidance listed by SSP. So what is important here? So even where the ISB has not issued a topic specific standard here, as it is case for the water, that does not mean that companies should ignore the issue if it's material. So instead, the standards explicitly allow and expect companies to look other relevant sources of guidance. And for water, you may think about CDSB water guidance. So also including industry standards and frameworks to identify disclosure, material sustainability related risks and opportunities. Of course, engaging a consultancy might be a good idea as well, and this is another option which will be reasonable in this case, but ignoring the topic or copying competitors' reporting, that's not the right way to proceed. All right, we're now handing over to Fiona, which will provide module summary for now. Over
Great.
to you, Fiona.
Thanks for that, Robert. So we're coming up now to the end of the module, as we say. So we'll just take a few minutes here to recap on what we've covered so far before we do our exercise as well to reflect on what we've heard so far. So, firstly, here we reviewed the purpose of sustainability related disclosures. And a key takeaway we're really hoping that you leave this workshop with is that there are important benefits, both internally and externally, for collecting and disclosing sustainability related financial information. And so ultimately, if you're not aiming to make good use of that data that you're already going to be collecting to improve your own strategic decision making, then you're really missing an opportunity here to get the most out of that information. Also, if you maybe have operations in difficult to abate or high impact sectors, it's likely that your competitors could already be disclosing their risks and identifying opportunities they're pursuing to their investors. And that will start to then leave your investors wondering why you're lagging behind and could start to affect your equity valuation or your access to capital. Next, we then looked at the evolution of disclosure standards and the formation of the ISSB with the aim to simplify the reporting landscape. And so when you're thinking about other voluntary disclosures, you shouldn't see those as competing with the ISSB standards, but rather building on top of them. And then finally there, Robert introduced the standards and the important concepts that you're going to need to understand in order to use them correctly. And a key point that I would like to reiterate from that is that the standards and the guidance that come with them are designed to meet the needs of investors. And so they're heavily focused on those prospects that we discussed at the very start of this unit relating to effects on financial performance and position. Okay, so to wrap up our module, we're now going to do a quick reflection exercise together. And so this feeds into the starting point for your organization's disclosure plan, which you can continue to build out through the homework exercise as well, if you'd like to. And so the first question we have to reflect on together is to think about how you're going to define the objectives for your organization's sustainability disclosures. So within your disclosure plan, it's really useful to be clear on what you're trying to achieve with your sustainability disclosures or any plans to adapt them. So you might want to define, for example, the particular reporting requirements you're seeking to meet. For example, the jurisdictional adoption of the ISSB standards, for example. And you'll also want to take into consideration where you are now when you're setting out this plan. So perhaps you might be starting from a complete new basis of disclosure, in which case you have obviously quite an ambitious goal to implement all of the processes and practices you need for reporting. But actually, of course, many organizations are going to have some existing approach to sustainability reporting. And so your objective here may be more so to adapt and evolve what you already have to meet these new requirements. And so that's the reflection question we have to get started with is what are your objectives that you're aiming to achieve through your sustainability disclosures? So good to try and get some clarity, I think, internally on what that is. So let's share the screen in Menti so we can see your answers coming through. We've shared the link again in the chat if anyone doesn't have access to Menti yet, so you can follow that link again to have a look at this answer question together. So let's see. So we've had some responses already. So thank you for those who've already inputted to this, and feel free to keep thinking in the background while we start to have a look at these together. So someone has mentioned here that as regulatory requirements for transparency, so maybe meeting that regulatory requirement and being transparent, and also looking to achieve net zero emissions. So good to keep that kind of overall target in mind that you have for your organization there and being transparent about your progress against it. Someone's also similarly mentioned regulatory requirements, but also looking to map the organization as a leader towards sustainable development. So maybe aiming to sort of competitively position yourself against your peers and to your investors. Enhancing transparency and accountability and clearly communicating ESG performance to stakeholders. Yeah, that's good. Good way of summarizing it as well. People have mentioned as well shareholders and investors again as a key audience here. So I think indeed keeping that investor audience clear here will hopefully help you to prepare disclosures that are aligned to their needs and are kind of concisely focused on what they want to know. Transparency again coming up. Someone's also mentioned around aligning with global frameworks. Indeed, so if you have particular frameworks, maybe your contribution to the Paris Agreement, for example, or the Sustainable Development Goals, there are also things you might want to consider. Attracting investors, improving performance, strengthening stakeholder trust. Yeah, all really good points to highlight. I think that management of risk and internal performance is a really good thing to evidence as well, particularly if you're trying to perhaps convince senior leaders of the need to focus on this topic and, allocate resources to disclosure. I think evidencing how actually the disclosure process can help you to better understand your risks and in turn use that to improve your organization's kind of operational approaches and strategic resilience is a really good thing to evidence the wider benefits beyond, the external reasons you might be doing this as well. Great. So long-term value is mentioned as well. So indeed having that longer horizon to your approach and thinking about those factors that could contribute in the long term to how your organization will transition or operate are really important points as well. Let's have a look. So to guide companies, so maybe this is, appreciate if you're not in a preparer perspective, maybe you're a consultant here. So that's no problem to highlight that your approach is to support companies on this too. So I see a few similar themes here, but it's some nice statements here, I think, that capture a good perspective between balancing those external drivers and stakeholder needs with also, realizing the benefits that you'll be able to gather internally from this. So I'd encourage you, I think, to, try and put in your disclosure plan a clear statement like this, which you can use as a common goal that you share with your colleagues and stakeholders so that it's clear from the outset what you're looking to achieve with your reporting. So thanks everyone who's shared your responses there. Okay, so I'll just take us back to the slide presentation now, and I think we'll be passing back over to Robert, if I'm not mistaken, who will get us started now on our next module.
Yes, thanks, Fiona. It's me indeed. Well, yeah, we're now moving to the next module, module 2, align. So far we introduced the initial concepts, and now we'll be diving how to apply the ASB standards, taking into account additional disclosures, including any relevant geographical or sectoral requirements, as well as peer practices and your leadership objectives. So in order to understand how to ensure your disclosures meet global standards, we look at two concepts in this unit. The first and the main focus of the unit will be on how to apply the standards as part of the global baseline for sustainability-related financial disclosures for capital markets. Once we cover that, we will also discuss how additional disclosures fit. So to begin, let's focus on how to apply the standards as a global baseline. So we will now start looking at those core content areas, and we'll start with the first one, which is governance. This aspect is centered on understanding how the oversight for sustainability-related issues is providing in the organizations through the processes, controls, and procedures that have been put in place at board and management levels. So for each of those content areas, we thought about some key questions that could be asked in your company to start identifying the information that will support some of the disclosures requirements. For example, as a part of gap analysis. So if we look at the governance and management requirements, we can see that there are several that are fairly qualitative. And these questions would be then, which bodies are responsible for the oversight and management of the processes, controls, and procedures of sustainability-related risks and opportunities? For example, is management responsibility delegated to a specific role or committee? Another question would be then how and when do they get informed about sustainability-related risks and opportunities? Further, then how there will be question how these issues inform the strategy, decision making, and risk management. This could include setting targets to manage sustainability related risks and opportunities. And then finally, there will be a question whether progress against these targets links to executive remuneration. So in order to further to help you to go through this process, you can make use of SSE checklist tool, but please remember that it's not a replacement for reading and using the full ASB standards. So we'll be now looking at a couple of examples to see how this can be done in practice. And again, over to you, Lois.
Thank you, Robert. So it's important to remember that these standards ask you for information about how you govern sustainability-related financial risks and opportunities, but they do not tell you what governance structure you put in place. That will depend on many factors, including the organization itself and whether and to what extent there are any governance codes or regulations applicable to your company. So when we show you these examples, that they will illustrate to you that there are a number of different ways of explaining how sustainability related risks and opportunities are governed. First example is from a company called Yara, which is a global crop nutrition company. It's got 17,000 employees and operates in 60 countries. And what we see here is a very highly integrated governance model. This is an extract from the Integrated Report 2024. And the big picture is that the responsibility for sustainability is embedded across different business functions, including risk management, health and safety, environment and quality, HR, global climate and energy, and so on. So about the governance process itself, the board of directors and president are shown in the dark brown boxes in the middle of the screen at the top. The Board Audit and Sustainability Committee, which you can see on the left there, assists the Board of Directors in overseeing the process for an internal control of sustainability reporting and material impacts, risks and opportunities. So they are there to assist the board, and the arrows show you the interaction between the board and the Board Audit and Sustainability Committee. The Sustainability Governance Team have a direct reporting line to the CFO. So you can see The arrows indicate that. And they are responsible for sustainability performance and reporting, and their work is very closely aligned with the corporate performance and risk functions. Then at the bottom of the screen, we see the Sustainability Network, which reviews Yara's accountability processes and systems in place for sustainability policies, and they monitor sustainability performance. And that network is chaired by the Chief Compliance Officer. And again, you can see arrows are used to indicate the flow of information and input between all these different governance bodies. So a number of different bodies assisting and reporting to the board of directors, and the sustainability governance team here reporting direct to the chief financial officer. Let's look at another example. This is an example from Petronas, which is Malaysia's national oil and gas company and a global energy company with presence in over 100 countries. So in this example, the governance structure shows the executive and non-executive and independent roles of the board of directors and the three committees to which the board delegates authority, responsibility, and operations. So you can see those three committees are the Audit Committee, which monitors climate reporting, and later in the report we can see that that's the body that also provides assurance on the state of governance controls and compliance in relation to GHG emission reporting. We also have a nomination and remuneration committee, which reviews the president and CEO's performance scorecard, which includes climate-related measures. And finally, we have the risk committee's work, which includes climate-related risk management and mitigation. At the bottom of the image, you can see that the executive leadership team's duties include sustainability, and that they also report to and assist the board. So this is an integrated structure like Yara's, where responsibility for climate and sustainability are embedded across multiple functions and three committees, not just one. And this is a structure that aims to provide role clarity and accountability, to promote strategic alignment across the group, and to facilitate decision making at all levels. And we're handing back to Fiona now to take us through the next section on strategy.
Great, thanks, Lois. So hopefully those examples have helped to make governance clear for us. We'll move in now to strategy, as we said. So strategy does have more disclosure requirements to include than governance, but we do also think it's really where companies can start to see the benefit from sustainability related opportunities and being better prepared for those risks. So this content area focuses on understanding what the company's strategy is for managing its sustainability related risks and opportunities. And there are three high-level areas that we'll focus on in the strategy content area. So that's risks and opportunities, their effects, and resilience. So we'll take a moment to review each of these separately. So IFRS S1 and S2 disclosure requirements on strategy are designed to enable users of the general purpose financial reports to understand a company's strategy for managing those risks and opportunities. And so if we first look at the requirements here are some of the questions that we might want to start asking ourselves internally to help us prepare this information. So when we're disclosing information about risks, this requires a description of the effects of the risk, the time horizons over which those effects are expected. And we also need to keep in mind here that the financial effects could occur before the risk or opportunity materializes or after or both, and can change over time. So that comes back to that time horizons point that I introduced at the start of the session here, which can be a little different when we're considering sustainability issues. And the other questions on this list are particularly relating to climate and come from the requirements in S2. So investors are particularly looking to understand the types of risks and opportunity that organizations have identified. And this is where they're asked to use the categories that draw from the TCFD of physical and transition risk. And both standards S1 and S2 also include guidance to support companies as they identify and disclose material information about these risks and opportunities. And they also recommend using industry-based guidance and the SASB standards to support this as well. So let's have another look at an example here to get some idea of what this could look like. So this example is from Mondi Group's 2024 integrated report. So Mondi is a packaging and paper company that operates across Europe, North America, and Africa. In the left-hand extract, we can see the different risks and opportunities that risks, I should say, that the company has identified and how those risks then align with four key categories, so strategic, financial, operational, and compliance. And they've also identified the delegated risk owners for those different principal risks as well. And then within the report, there's a lot of information and description to explain these risks and their effects more thoroughly. And then on the right-hand side here, we see that as climate change risk was identified as one of the principal strategic risk categories, they've then further disclosed and categorized between physical and transition risks and opportunities the individual climate-related issues that they expect to face or potentially could face. And so they also include here more detail that goes into some of the things we'll talk about in a moment around the estimated financial impact of these risks and the different time horizons and scenarios that we've used. We won't focus on that for now, but just to keep in mind that this is perhaps a useful example to refer to for those points as well. And so I started to touch on it there, but another aspect of this content area that needs to be disclosed really brings us back to what we were talking about at the beginning of the workshop regarding time. So you might remember when we discussed this that the time factor is something that can be quite different when we're talking about sustainability related disclosures. So let's be sure that we're clear what we mean here. So the standards ask that you identify within what time horizon the effects of each sustainability related risk or opportunity could be reasonably expected to occur. And the definitions of short, medium, and long-term horizons can vary between companies and depend on many factors. So, for example, this could include the investment and business planning cycles of the organization, its strategic planning horizons, the lifespan of its assets that it operates, or other factors like the assessment periods that its investors use. So it is important for the company to select appropriate time horizons to commensurate to those variables and how they affect its company. But what's important to remember is that the organization does need to define and clearly disclose the time horizons that have been used to enable your investors to understand that in your context. So moving on now to the second group of disclosures in the strategy category. So the first section there was around identifying what the risks and opportunities are. And then this next set of disclosures is focusing on understanding the effects of the risks and opportunities and where these effects would be likely to occur in the business. So to start tackling the disclosure requirements of the standards here, companies will want to start asking themselves questions such as, what are those effects? What responses do they have planned to mitigate or adapt to the effects? And thinking about where in its business model or value chain in particular it's expecting those effects to occur. And so we'll show you another example here, which comes from the global chemicals company BASF's annual report. And this is just a sort of small visual summary of the detail of the report. I think with all of these examples, obviously, we can only get a small amount of the disclosure onto one slide. And even then, we know it's quite small. So we do encourage you to look at the report. But this diagram, I think, gives a helpful flavour of the approach they've taken to really illustrating how different climate and sustainability related risks and opportunities are going to affect different aspects of its value chain and how it's responding to that. So, for example, within the upstream area of their value chain, they focus on explaining how they are kind of prioritizing and improving their due diligence processes to incorporate sustainability factors and think about procuring more bio and renewable based materials. Within their own production, they then talk about the efforts they're undertaking to manage risks relating to energy use, so improving energy efficiency of their own processes and reducing their carbon emissions alongside that. And then finally, within the downstream, they really talk about the rising demand that they're seeing from customers and a potential willingness to pay more for sustainability projects as well. So in that area, they're kind of really thinking about how they can design their products to meet the needs or potential future needs of customers, and prioritize those segments where they see potential growth for sustainability related products and services. And in the commentary alongside this, they talk about the target that they've set to achieve 10 billion euros in sales revenue by 2030 from projects that contribute to circular economy and sustainability. So, a useful example, perhaps, of how the company has illustrated the effects of risks and opportunities across its business model and value chain, and made those connections then between its strategy, its sustainability target, and how it's investing in technology to support that. So, one question we know that sometimes arises here and can be a real challenge is what kind of detail needs to be disclosed here? And does this information needs to be quantitative as well as qualitative? So, a company is required to disclose both quantitative and qualitative information about the current and anticipated financial effects of sustainability related risks and opportunities. However, the standards do also set out criteria for when only qualitative information is required. So, using only qualitative information is permitted for a number of reasons. So, firstly, if a company can't separate the effects of a sustainability related risk or opportunity from other effects, so it's not possible to isolate and understand the sustainability related effects specifically. Secondly, if there's a high level of measurement uncertainty. And finally, if the company doesn't currently have the skills, capabilities, or resources to provide that quantitative information. So that brings us now to the final part of the strategy component, which is all around resilience. And so this really gets into the practices and processes that the company has in place to assess its own resilience and to make strategic adjustments where it needs to. And disclosures here will include information on how it's carried out this assessment and what time horizons have been used. And so for climate-related developments and uncertainties, IFRS S2 additionally requires the use of climate-related scenario analysis, using an approach that is commensurate with the company's circumstances. So companies there are asked to assess climate resilience and to disclose the key inputs and assumptions that have been used in that scenario analysis. So we're going to dive into scenario analysis in a little bit more depth in a moment, but some of the top line questions that you might want to start by asking here will be considering what is the company's overall capacity to react or adjust to those related risks and opportunities that we've talked about, and how are climate scenarios or other types of scenarios being used to assess and test this resilience. So looking at another example here, we have one from the company Stora Enso, which is a Finnish and Swedish forest products company. And in these diagrams here, they're showing us a picture of how they're expecting their sales and revenue to change in the future, because they've distinguished, I guess, between their core or business as usual activities relating to pulp and paper products and where they potentially see future growth coming from, relating to biomaterials, renewable packaging, and sustainable buildings as well. They show in that bottom visual as well how they expect the makeup of their sales revenue to change over time to be increasingly coming from these new business areas. So they've sort of provided a picture here of actually they might expect some potential loss of revenue from the business as usual activities of today, but there is potential growth coming from these new activities as well. And so, alongside this, they explain some of the actions that they've taken to really capitalize on this and to start to invest in what they need to capitalize on that growth. So, for example, acquiring new companies that work in those areas, maybe investing in innovation or converting their machinery as well. And our second example here comes from Marks and Spencer, which is a British retail business. And this comes from their disclosure about the impacts of climate-related risks and opportunities on the company's business strategy and financial planning. So there's quite a lot of information here, but we'll just sort of walk you through at a high level what's included. So in that first column there, the description of the specific risk or opportunity is provided. So they identify in the top line a transition risk relating to environmental compliance. And the second row is a transition risk and opportunity about keeping pace with customer trends and preferences for sustainable products. Then in the other columns, they explain which parts of the business they're expecting to be affected by that risk or opportunity and the time horizons that are applicable there. They'll then talk around the quantification of risks if they're able to provide quantification of the financial impacts of the risk. And the different types of financial impact they might expect to see, for example, increased operating costs or capital expenditure. And also, there's then a reference as well to the company's financial statements for further information about those capital expenditure costs. And finally, in the last column, they talk about the business responses to this risk and how they've identified ownership and targets to help them manage these issues. Okay, so that brings us to the end of the strategy content area. So to wrap this one up, we'll just have another poll now, which tests one of the concepts that I mentioned to you a little bit earlier in this section, just to see if you can remember what we discussed there. So if you recall, we talked about a number of reasons why it might be permissible for companies to provide only qualitative information or a mix of qualitative and quantitative information about the financial effects of sustainability risks and opportunities. And can you remember which of these are correct options? So you can select more than one here if you think more than one of them is correct, but we'll just give you a moment to have a little think about that before we have a look at the right answers. Okay. Let's give it a little bit longer for a few of you to take part. Don't ever worry about getting the polls wrong as well, of course. It's all anonymous and just about your learning. So it's always good to have a guess and see what you think. But yeah, don't worry if you don't know the right answer. That's why we're here today in a training session, of course. Okay, let's close the poll there and I'll have a look at the results. So most of the responses seem to have highlighted the first option. So if you can't separate the effects from another risk or opportunity, or if there's a high level of measurement uncertainty. And indeed, that's correct. Those are the two right answers. So as we covered, these are both criteria in the standards which are permissible. However, option C is incorrect because, of course, it is important that our disclosures are balanced. So if we do have quantitative information about potentially material negative financial effects, it's important that we are providing this transparency to our investors. And indeed, we saw that this was the case in those disclosure examples that we just talked about there, where companies were disclosing financial effects for both risks and opportunities as well. Okay, so we're going to have a look at the climate aspect of this area in particular, which I'll pass back to Lois for.
Thank you, Fiona. Some of the recommendations or the strategy content areas like risk management and governance are very similar, almost the same across S1 and S2. But when it comes to strategy, and metrics, there are very specific additional requirements in S2. So we're going to take a look at those now. So the climate-specific strategy points that we see in IFRS S2 require a company to refer to and consider the applicability of industry-based disclosure topics. Now, you can find these in the industry-based guidance on implementing climate-related disclosures, which is one of the documents that accompanies S2. And there you might find, for example, that if you're in the construction industry, you will be asked things like, well, how much waste did you generate? How much of it was recycled? What percentage of it was hazardous? And perhaps how many, if you're in construction materials, which of your products qualified for credits in sustainable building design. So secondly, S2 requires you to provide more detailed information on where in the business model and value chain risks and opportunities are concentrated. This enables your investors and stakeholders to understand where the main risks are. And this might be physical risks. So for example, you have some physical assets in areas that are vulnerable to extreme weather events. Thirdly, you are to provide detailed information on the effects of climate-related risks and opportunities. So how will they affect your business? There are, S2 sets out criteria for when quantitative and qualitative information is required for the disclosure of a company's the anticipated and current financial effects of sustainability related risks and opportunities. So disclosure of qualitative information only is permitted under some circumstances. Fiona's mentioned them already, for example, where a company cannot separately identify the effect of the risk or opportunity, or when the level of measurement uncertainty is so high that it would make the information not useful. Then, when preparing information on the financial effects, S2 requires a company to use all reasonable and supportable information available to it at the reporting date without undue cost or effort, and to use an approach that is commensurate with the company's circumstances. So this recognises, of course, that some of these disclosures are very difficult to make, and we're going to talk about this a bit more a little later on. Then the penultimate point is that in using climate-related scenario analysis, S2 requires the use of an approach that's commensurate with the company's circumstances, as we said above. And S2 doesn't specify which particular scenario or scenarios a company must use for its climate-related scenario analysis. That is for the company to decide. And finally, S2 requires a company to provide information on its resilience to climate-related risk based on the scenario analysis or otherwise. And in doing that, it must set out what significant areas of uncertainty it has considered in making its assessment, and also what is its capacity to adjust and adapt its strategy and business model over time. And of course, details are required about when and how and which climate scenario analysis was used. So when disclosing the effects of climate change and what the company's doing, a company might decide that it will set a climate transition plan. So what is a climate transition plan? Well, it's defined as an aspect of the company's overall strategy that includes targets, actions, or resources for the transition towards a lower carbon economy, including, for example, greenhouse gas emissions reductions plans. Now, S2 does not require a company to have a transition plan, but there may be local requirements that mean that you do have to have one, and if you do, S2 requires you to disclose information about your climate transition plan. So let's talk a bit about what a transition plan is, its characteristics. Well, because it's an aspect of a company's overall strategy, it should align with that strategy, including the business case and motivation for transition and the levers that the company's strategy is most suited to using for decarbonisation. Secondly, the transition plan should or could be aligned with science, including what science says about requirements for net zero to be achieved, and how carbon neutrality or Paris-aligned goals are explained in terms of the science and what that means for your transition plan. Thirdly, the transition plan should include long-term goals with clear mitigation and adaptation activities and targets, and interim goals and targets to monitor progress along the way to the transition plan. The transition is uncertain, of course, and therefore the plan should be transparent about the dependencies for the plan's progress and success, the risks and challenges of implementing the plan, and how residual or unabated greenhouse gas emissions will be handled. The uncertainty also exists at the sector level because the transition will proceed in different ways and at different paces for different sectors, and therefore sector-specific pathways should be consulted to inform the development of the company's transition plan, and we're going to look at some of the resources available for this in a moment. And finally, the transition plan should consider how others will evaluate it, which stakeholders and investors, what they would regard as the hallmarks of credibility of the plan and how the plan will be assessed. And we're going to talk about that as well in this slide here. Now, there are loads of resources about transition planning. We focused on a few here. First of all, the IFRS Foundation published guidance entitled Disclosing Information about an Entity's Climate-Related Transition, including information about transition plans in accordance with IFRS S2. And that guidance was issued less than a year ago, so it's quite new and it contains lots of examples and relevant information. Secondly, on the screen in the thumbnails, you can see the UN SSE's model guidance on climate transition plans. This has a bit more of a focus on practicalities of transition planning, and it has an appendix which sets out the hallmarks of a credible transition plan. Thirdly, we see a publication from GFANZ, the Glasgow Financial Alliance for Net Zero, and this sets out sectoral pathways of the transition for financial institutions. They do offer other sector pathway guidance as well. And finally, we talked about the Transition Plan Task Force, whose work has been is taken over by the ISSB, but still exists as a separate piece of guidance available on the ISSB website, and this is a very useful framework with additional guidance on disclosure of transition pathways. Now, the triangle on the left is simply designed to show you that each of these pieces of guidance is intended to support and build on the ISSB's work. So lots of useful information there to help you with your transition planning. Now, you'll be glad to hear we're about halfway through, so we're going to take a short break now. So take this opportunity, please, to have a stretch, a drink, to think about any questions you'd like to ask us. We'll play you some relaxing music and see you back here in 5 minutes. Hello, everyone, and welcome back after that short break. I hope you're feeling a little refreshed and ready to move on to our next, the third core content area, which is risk management. And this category of disclosures focuses on enabling investors to understand a company's processes to identify, assess, and prioritize and monitor sustainability related risks and opportunities. So let's have a little look in more detail at this category. In the strategy content area, we were also talking about risks and opportunities, weren't we? But in that case, the focus was on the risks and opportunities that the company had identified that could reasonably expected to affect the company's prospects. In this core content area, though, we focus on how the company identifies and assesses the risks and opportunities and what processes they use. So questions that IFRS S2 asks and S1 are about what processes and policies the company uses to identify, assess, prioritize, and monitor sustainability related risks and opportunities, and how are they integrated, if at all, into the company's overall enterprise risk management process. So what you might start to think about internally is what inputs and parameters do you use for risk management? And are they the same across all types of risk, or are there different inputs and parameters for sustainability related risks and opportunities? How do you prioritize sustainability related risks and opportunities, including what criteria are used for assessment? Is it nature and likelihood, probability, magnitude, or other criteria? And are those criteria the same as for your standard enterprise risk management processes? And you'll also need to think about whether and to what extent and why these processes change over time. So let's have a look at an example of how BMW, the German car manufacturer, reports their risk management processes. Now, they describe their process here in an extract from their 2024 group report in terms of words and diagrams. And of course, this is only an extract. The company reports risks and opportunities for the current and subsequent financial year. So there's a little bit of forward-looking information here as well. Turning to the process as summarized in the diagram, around the edge of the circle, we see the word appropriateness, which refers to the risk culture that's embedded in BMW's core values, and effectiveness, referring to the effective management of risks and opportunities that they say in the narrative, in the little inset there, is the foundation of their business success. So they say that how effectively they manage risks and opportunities is actually the foundation of their success. Down the left-hand side of the circle in the red and blue smaller circles, we see the group compliance and internal control systems that form key interfaces with the risk management system. So the process is not the responsibility of the risk department alone. Risk management is steered as a centralized risk management function, although it's organized globally as a decentralized network with different network representatives. The process itself, as we see on the inside in the light blue spokes of this wheel, it involves early identification, analysis and evaluation of risks, use of appropriate risk management tools, including the measures taken to manage those risks, monitoring and assessment of the measures taken, and risk reporting. So having done that, all material risks are then reviewed by the Risk Management Steering Committee. You can see that in the white circle there on the right-hand side. That is chaired by Group Controlling, and any material risks are then reported to both the Board of Management and the Supervisory Board's Audit Committee. So a full description of the process there, and of course there's much more in BMW's report. And we do have some climate specific considerations about risk management in S2. S2 requires that a company provides information about the input parameters used to identify risks, including whether and how climate-related scenario analysis was used to inform risk identification. Now, scenario analysis is mainly used for resilience assessment, but can also inform risk identification and management. S2 also asks for information about whether risk management processes have changed over time, and similar requirements apply about the identification, assessment, and monitoring of opportunities. In S2, we do have a definition of climate-related risks, and this is based on the work of the Task Force on Climate-Related Financial Disclosures. Basically, there are two types of climate-related risk. Transition risks arise from efforts to transition to a lower carbon economy, and they in turn are often characterized as policy and legal, technology, market, and reputational risks. We see some examples in the middle column. These could be things like increased pricing of greenhouse gas emissions, more reporting obligations, exposure to litigation, costs of transition to the use of lower emission technologies, different customer and consumer behaviors and trends, uncertain market signals, stigmatization of certain sectors as a whole. Then the physical risks, the second type of climate-related risk, include risks from climate change that can be event-driven. These are acute physical risks that arise from weather-related events such as storms, floods, droughts, and heat waves, which are increasing in severity and frequency, or chronic physical risks that arise from longer-term shifts in climatic patterns, including changes in rainfall and temperature, sea level rise, reduced water availability and quality, biodiversity loss, and changes in soil productivity. Now, in both cases, these types of risks can give rise to financial implications for a company, such as costs resulting from direct damage to assets or indirect effects from supply chain disruption. So these financial effects can show in differences in cash flows, changes in access to finance, the cost of capital, and those effects can be felt over different time horizons. Similarly, in S2, we have a definition of climate-related opportunities, and these refer to the potential positive effects for a company arising from the transition to a lower carbon economy, like the example Fiona gave earlier of Stora Enso, who are developing biodegradable packaging sources, for example. So the types of opportunities that we see can involve improving resource efficiency, changing to lower emission sources of energy, developing new products and services and technology, accessing new markets, being able to differentiate yourself against your competitors, and finding opportunities to substitute resources for lower carbon resources or diversify your inputs. So again, these can have financial effects on your cash flows, access to finance, cost of capital over different time horizons. And an investor could look at your sector, see your disclosure, and be very interested in your opportunities and those of your competitors, and analyze the way in which you and your competitors are identifying and capitalizing on the same or similar opportunities. Let's have a look at an example now. This is an example from RS Group, which is a UK-based distributor of electrical and industrial equipment. They have global operations. It's important to say that this is just a very small extract from their risk disclosures, and it follows earlier in the report identification of 10 principal risks, one of which is climate-related transition and physical risk to their business. And this extract is about some of the physical risks. So they tell us that the most significant physical climate risks relate to the impact of extreme heat on their distribution centres and the potential for extreme weather events to cause physical damage and disruption to their customer supply operations. So we see this in the first column. In the first column, we also see a little red wheel icon, and this shows us that strategically the risks mainly affect operational excellence. You can also see the connected stakeholder icons, which show us the stakeholders that are most affected by this risk. In the second column, the risk is described in full. The third column tells us which business owner is responsible for monitoring and managing the risk. The fourth column is about which metrics are used to monitor the risk. One of which, for example, is insurance costs. Are they changing because of the degree of the risk? And finally, in the last column, we see the actions the company is taking to manage the risk, including through building upgrades and associated capital investments and business continuity planning. So quite a comprehensive example there from the RS Group to help us understand risk management and associated processes. I'm going to hand over to Robert now to take us through the next core content area.
Yes, great. Thank you very much, Lois. Indeed, we'll be now moving into the next core content area, and that to be metrics and targets. So we'll be now spending some time reviewing them in more detail. Here, disclosures are intended to enable investors to understand how the company is performing with respect to its sustainability-related risks and opportunities. So again, as with all core content areas, there are a number of questions we would like to then go through. We'll then start with metrics. So requirements on metrics are designed to enable investors to understand companies' performance in relation to its sustainability-related risks and opportunities. So prepare share disclosure information explaining how the metrics are defined, if they are absolute or relative, if they have been validated by a third party, as well as methodology. For example, what is the method of calculation? What are the inputs? Are there any limitations, and what assumptions are involved? So these are the elements you should consider when thinking about the metrics, or you should not consider, but you should disclose in regards to metrics. And for the targets, so the requirements on targets are designed to enable investors to understand what targets the company has set to monitor progress towards achieving its strategic goals, as well as any targets required to meet for regulatory purposes. And disclosure then shall include whether these targets are qualitative or quantitative, and whether it is set voluntarily or required by law or regulation. Obviously, they need to include the metric used to set the target and also to monitor progress towards its achievement. You would also need to disclose the baseline period from which progress is measured and period to which the target applies, what are the milestones and interim targets, and finally, if there have been any revisions to targets with an explanation about those revisions. And we will have now an example on this topic. Over to you, Lois.
Thank you, Robert. And this example is from a company called CLP, which is one of the largest investor-owned power businesses in Asia Pacific, aiming to be a leading responsible power provider. It's an extract from their 2024 sustainability report. Now, you've probably noticed that many of the examples we've shared with you in this webinar so far have been about climate. Well, here we have one about waste management and material use. And we currently don't have a standard on waste management from the ISSB, but that's fine. We're going to look at how CLP has dealt with this. They are using SASB and GRI to calculate their waste management and material use metrics, and those metrics are shown in the table below. Now, what's interesting is that the waste management and material use metrics have been set because it's part of CLP's strategy to manage and reduce the total waste produced. So you can see that they're showing us in the table their 2024 results and whether they are in line with the target that they've set by the end of 2025 and by the end of 2030. So they're comparing their progress with their baseline. So just a small example of metrics there, just to illustrate that there's more than climate that a company might want to measure, and that it is possible to use SASB and GRI standards to do that. So let's look now. I think, Robert, this is back to you, isn't it, for
Yes.
climate-specific metrics and targets?
Yes, great. Thank you, Lois. Yeah, we'll be now moving to and focusing on the climate specific considerations. So the metrics and targets in covering the climate. So in relation to IFRS S2, in relation to metrics, IFRS S2 requires a number of specific disclosures related to climate. So, firstly, IFRS S2 requires disclosures of industry-based metrics relevant to company business model and activities. Additional disclosures are required on greenhouse gas emissions, including separate disclosures for the consolidated accounting group and associate joint ventures, and information about companies' finance emissions. In addition, IFRS S2 also sets out a Scope 3 measurement framework to provide guidance for preparing Scope 3 greenhouse gas emission disclosures. And finally, important to note why IFRS S2 does not explicitly require a company to disaggregate its greenhouse gas emissions disclosures by their constituent gases. IFRS S1 includes requirements on disaggregation that would result in a disclosure of the constituent gases being required if such disaggregation provides material information. So I'd like to remind here also everyone that you can access more information on climate metrics in the SSE's training tool on this topic. We'll share the link in the chat, and you can also find it on the SSE's website. So that's about the metrics. And now let's talk about climate specific targets. As for metrics, there are some climate specific disclosure requirements in S2 for targets, and these are, for example, IFRS S2 requires disclosures about how the latest international agreement on climate change has informed the target and whether the target has been validated by a third party. IFRS S2 also requires disclosures of more detailed information on greenhouse gas emission targets, including additional information about any planned use of carbon credits to achieve a company's net greenhouse gas emission targets. And finally, IFRS S2 also includes additional requirements to disclose information about the approach to setting and reviewing each target and how it monitors its progress against each target, including whether the target was derived using a sectoral decarbonization approach. Right, and let's then talk about the greenhouse gas emission metrics, as these often there's a lot of questions coming up in that regard. So let's then address them here briefly. So for those who might not be familiar with the different scopes, there are three scopes which defined in Greenhouse Gas Protocol a corporate standard. So scope 1 includes all direct emissions that occur from sources owned or controlled by companies, such as emissions from the company's facilities or vehicles. Scope 2 includes emissions from generation of acquired and consumed electricity, as well as steam, heat, or cooling So that will be the electricity you purchased. And scope 3 is then all other indirect emissions that occur in the company's value chain. So S2 requires a company to disclose its absolute gross scope of 1, 2, and 3 greenhouse gas emissions in accordance with the Greenhouse Gas Protocol corporate standards, unless a jurisdiction requires a company to use a different approach to measurement. If a company is using the different measurement method, there is a transition relief to use that method in the first year of applying the standards. So, and then S2 also requires a company to disclose whether and how the company is using an internal price on the carbon for decision making, as well as whether and how executive remuneration is linked to climate related considerations. And on that topic, last year in May, the IFRS Foundation has published educational material presented in the Q&A format, detailing the greenhouse gas emissions disclosure requirements under IFRS S2, and we're sharing this educational material in the chat. Okay, we have another example, and it will be presented again by Lois. Over to you.
Thank you, Robert. And yes, that educational material is really well worth looking at, but let's have a look at an example, and bear in mind this may have been produced before the educational material was released. This example is from Vale, which is a metals and mining company, from their 2024 integrated report. Quite complicated, but we'll break it down. The tables in the middle of the screen under the title Greenhouse Gas Inventory show us greenhouse gas emissions broken down by scopes 1, 2, and 3, as well as comparative figures dating back to 2022 and to the baseline year from which GHG emissions reductions were set in 2017. So you can see the trend over time and the breakdown between the scopes. The circular diagram on the right of the screen shows the greenhouse gas emissions broken down by source. So where do the emissions come from? And the colours tell us that mobile combustion activities give rise to the most greenhouse gas emissions by source, followed by industrial processes. Notes and symbols on this extract tell us how the results have been prepared, and the inventory has been prepared using GRI's greenhouse gas emission standards, GRI 305. Note 1 tells us that the GHG emissions inventory has been assured by a third party. And note 2 tells us that the GHG emissions have been reported on a gross basis before any type of compensation or mitigation, and that is what is required by IFRS S2. At the bottom of the page, there's an overview of the company's long-term commitments on climate change and a report on their progress. So the baseline for Scope 1 and 2 targets were set in 2017, as we can see in the comparison column. And the aim is to reduce emissions by 33% by 2030 and to achieve net zero emissions by 2050. And by 2024, the company tells us it's made 81.5% progress towards the target. And they give us similar insights about Scope 3, about how their actual performance compares to their baseline. So a lot of information about how greenhouse gas emissions are broken down and compared against targets and what the trends are over time in this example. Let's do a Zoom poll now. And the Zoom poll asks, what is the objective of metrics? And you can select all that apply. Now, when we refer to the objective, I mean, what is the objective of the ISSB's disclosure requirements on objectives? Is it to enable report users to understand performance in relation to sustainability-related risks and opportunities, to understand progress towards targets, or to understand the company's assumptions for the future? Just give you a moment to think about that. I'm going to share the results now in the interest of time. And actually, you've selected all of the answers, and the proper answer is 1A and B. Now, the reason we've asked you this question in this way is to encourage you to read the standards, because at the start of every content element, the ISSB standards set out the objectives of the content element. In the case of metrics, the objective is to understand the company's performance in relation to the risks and opportunities and to understand progress towards any targets. Now, number 3 may also happen. Yes, the metrics will help readers understand the company's assumptions for the future. But the reason we're asking you this way is that if you're in any doubt about what to report, have a look at what the objective of the disclosure requirements are, because that will really help you to focus your disclosures. So we're going to turn to the next part of the module now, which is about additional disclosures and how we've covered all the core content areas that the ISSB standards ask for, but you may have to disclose additional information because of local regulatory requirements or because it's in line with management's objectives. So how do you do that? And we're just going to cover it quite briefly. So you may need to disclose additional information in addition to the ISSB standards requirements, because there are listing requirements that mean you have to, because you have policy objectives that you want to disclose information about. So, for example, if you were offered incentives like tax cuts or subsidies for sustainable practices, you might want to say something about that. You might want to make disclosures that align with emerging industry and sector practices. And you might want to make disclosures to help stakeholders other than investors understand your sustainability strategies. All legitimate reasons. Now, the standards on the adoption of ISSB gathers momentum. So this sets the baseline. As of December 2025, 39 jurisdictions had adopted, used, or were finalising the adoption of the ISSB standards. If you would like to know more, there's a link there to the ISSB pages on jurisdictional profiles and snapshots. The ISSB also published their jurisdictional guide in 2024, which helps us to understand how they are engaging with different jurisdictions for the adoption of their standards. There's other links here to resources you can look at if you want to understand how the ISSB is working with jurisdictions around the world for adoption of the standards. So, we know that there's the global baseline, there's a jurisdictional program, and that you can make additional disclosures. So what about if you are using CDP or the GHG protocol, etc.? How is interoperability, as they call it, and how are strategic relationships with these other organizations managed? I'm only going to go through one of these because we've already talked about CDP GRI, Transition Plan Task Force. Actually, I'll mention two. First is Greenhouse Gas Protocol. Now, this is the protocol that must be used for the measurement of greenhouse gas emissions unless there are overriding regulatory requirements. Just want to reassure you here that the ISSB works with the GHG protocol team on technical updates and on governance arrangements to ensure maximum alignment and interoperability between the ISSB standards and the specifications of the GHG protocol. Then the last bullet point to cover here is about the work of the Task Force on Nature-related Financial Disclosures. Now, if you look at the ISSB website, you'll see that there's an ongoing project where the ISSB is considering how to build upon the recommendations of the TNFD to meet investors' information needs and to produce a standard or materials about disclosure of nature-related information. So interoperability work is ongoing. We've already talked about the fact that the GRI and ISSB work closely together to ensure that there is as much alignment between their disclosures as possible. The important thing to mention here is that a statement was issued in June 2025 confirming that the GRI's standard setting board had granted equivalence to IFRS S2's Scope 1, 2, and 3 disclosure requirements, which means that companies only have to prepare their Scope 1, 2, and 3 information once in order to conform with both GRI and ISSB. And there's an ongoing collaboration for full interoperability on the GRI's biodiversity standard, and that will link into the project I just mentioned that the ISSB is conducting on biodiversity ecosystem and ecosystem services. Now, maybe not so much for this audience, but just to note that the ISSB works closely with the European standard setters as well to ensure that there is as much alignment and interoperability as possible with European standards and the European sustainability reporting standards. I won't go into this in detail except to note that on climate-related disclosures, a high degree of alignment between the two sets of standards has been identified, and of course the work to ensure alignment is ongoing. Finally, integrated reporting. From the Zoom poll earlier, I saw that not many of you were using that, but if you do use the integrated reporting framework or any of its resources, just to reassure you that the integrated reporting framework can be used as a complementary tool for investor-focused communications on sustainability related risks and opportunities. And if you're interested in using that, we give a link here to a report called Transition to Integrated Reporting, which is really a practical guide to how you can use integrated reporting to help you provide a more holistic view of your company's value creation process and a more complete picture of how value is created over time. So there we have a brief overview of how you can use different resources to support your ISSB disclosures and to make additional disclosures, of course, without obscuring the information required by the ISSB standards. So Fiona's now going to take us through a summary of Module 2.
Great, thank you for that, Lois. So, as we're wrapping up this module now, we're going to take a minute to remind ourselves of what we've learned so far. So, we learn around those four core content areas of the ISSB standards. So, that's governance, strategy, risk management, and metrics and targets. But an important thing to remember, of course, is that these don't operate in silos. So, we saw in the disclosure examples that we shared with you that despite those being four separate categories of disclosure, of course, in reality, they're all interconnected and need to be presented as such. And we also discussed how your disclosures could go beyond the requirements of S1 and S2. For example, to meet different stakeholder needs, to meet regulatory requirements in certain jurisdictions, or to meet industry standards. And so what's important to remember when you're doing this is that the ISSB standards have been purposely developed to act as a baseline. And that building blocks approach allows report preparers to add additional disclosures on top. But of course, in doing so, you do also need to be careful that you're not obscuring the requirements of S1 and S2 as well. And so hopefully those resources that we've shared with you there that show the mapping and connection to different standards can be useful. Of course, there's lots of information there, so try not to feel too overwhelmed. Not all of it is likely to be relevant for you, but you can make use of those resources that connect to whichever standards and frameworks you may already be using. Okay, so we're going to go back to Menti again now for our exercise to wrap up this module. And so what we'd like to reflect on now is you've heard, of course, what those core content areas are, and we've walked through that in detail. And probably what might have been coming to mind for you as we worked through that were some areas maybe that you need to address or improve in your own processes or disclosures to respond to the new requirements. So what we'd like to take a moment on now is to reflect on what gaps you think you might have. And so, of course, what we'd recommend that you do more thoroughly within your own organization is to conduct a gap analysis. So we've developed a checklist at the SSE to support you with that, and that's available in the toolkit of resources that we've shared with you from the SSE. There's also a simplified version of this within the homework assignment, which you can use as a starting point. But just to get us going on thinking about that, we'd like to take a moment to reflect together in Menti. So, firstly, we can think about any gaps that we might have, maybe in terms of particular reporting requirements. So, that could be around any particular disclosure information, maybe that is missing at the moment that you would need to provide to meet the standards. But also, you might be reflecting already on other types of gaps. So maybe you need some new processes, some new skill sets. You need to identify a particular type of data that maybe you don't currently have access to inform your disclosure. So we can think about those types of gaps as well. So let's go back to Menti now. So let me reshare the Menti screen. The link will be in the chat for you as well. And you can let us know maybe what's front of mind for you as we reflect at this point about any gaps that you've identified. Um, of course, it's understandable that there will be gaps. That's, I think, inevitable to an extent. So hopefully it's helpful just to get a sense of what others are reflecting on here, and maybe they'll be able to identify gaps that you hadn't thought of that maybe would apply for you as well. And later, we're going to come back and think about how we can start to identify data that can help us to address those gaps as well. So I'm seeing a mention of auditing standards. I know we had a bit of a discussion on that in the Q&A as well. So maybe identifying that auditing is something you feel is important. Of course, whilst the requirements on that develop, it's very much a possibility that you could choose to undertake voluntary assurance of your disclosures. You could either use the existing standards to do that, or you could also consider maybe conducting assurance readiness to ensure that you're in a good position when potentially auditing may become mandatory in your jurisdiction in the future. But that's, as we said, a matter of a jurisdictional adoption of the approach there. Let's see some of the gaps we've seen mentioned. So someone has mentioned about data availability and quality across topics. So yeah, maybe you've got more data on some topics than others at the moment and need to sort of broaden out that more holistic understanding of different risk and opportunity types. So strengthening internal controls and data collection. Yeah, that sounds like a great approach. So having that confidence in the data that you're using internally to underpin your disclosures is definitely very much recommended, of course, as we're moving towards mandatory adoption. So we're seeing maybe comparing frameworks and reporting standards. So perhaps you're referring there to needing to compare what you might have reported under voluntary frameworks to the standard requirements from the ISSB. So hopefully those mapping documents we've shared can be useful to inform that. Someone has mentioned materiality and maybe, yeah, applying a more clear materiality lens, that financial materiality lens to your disclosures and information may be a new thing to do. So definitely worth getting your head around there and starting to think about. Someone's mentioned also the risk process. So indeed, you may need to make some adaptations to your existing risk processes to enable you to sort of more thoroughly assess and understand these types of risks and opportunities. So indeed, that's quite a common thing I think that many organizations might be considering at this point in time. Let's see what other options we've got here. So someone has mentioned as well around Data quality and consistency and completeness across all metrics. Yeah, so obviously now the standards put more emphasis on having that comparable and consistent data across years and reporting standardized metrics. So making use of the SASB standards and those additional industry sources to help you develop those metrics is a good idea for sure to build out that comparable approach. So someone's mentioned maybe the banking sector being the sector and wanting to look at more resources to support that. Yeah, definitely. There's a lot of resources out there kind of focused on the finance sector. For example, materials produced by the UNEP Finance Initiative, UNEP FI, could be a good resource to refer to for some guidance on that topic. Um, let's have a look. What else? Someone's mentioned supplier risks. Yeah, that's a good point as well. So, of course, it's often easier to start with assessing operational risks within our own kind of organizational boundary. But of course, it's very relevant here to consider your entire value chain because there could be risks or opportunities for your company that relate to the activities of your suppliers as well. So, thinking about how you can start to assess that. Um, uh, Even if it's a qualitative assessment at this point, or maybe you're focusing on key suppliers or key products or locations where you potentially think there could be risks to get a better understanding is a good idea. Funding, I think that's an important point to highlight here as well, because indeed, for many organizations, we're probably in a little bit of a transition here from a stage where sustainability reporting was a voluntary exercise. It might have been managed by one individual or a small team, maybe alongside a broader remit of sustainability. So, what we're actually seeing now, of course, is that many teams are needing to increase the resource that they've allocated to this significantly to build out these more robust and comprehensive approaches. And so I think that's where, really engaging with your leadership about this plan and the requirements is important in an early stage in the process to ensure you're building understanding of, the requirements here and that really they need to be thinking about this much more on a level with traditional financial accounting in terms of the resourcing requirements and, getting clear about that expectation up front so that you can allocate the right resources to this and ensure you've got the right internal skill sets as well on board to support your reporting. Okay, but thank you everyone who's reflected there. I think lots of really valuable points to highlight. So overall, indeed, what we really encourage you to do after this training is to take this away, start to build out a better understanding of what those gaps might be for your organization. And really, I think the most important thing here is to understand what those gaps are and to start to build out some prioritization as well. So some gaps may be higher priority to address ahead of your first disclosures. But actually, there may be some areas that could be more areas of continual improvement that you evolve over time as reporting matures. So if you can provide transparency in your first disclosures about what those gaps are and what your plans are to address them, that's going to put you in a good position to also respond to any stakeholder inquiries that you might get about that as well. Great, thanks everyone. So this is going to bring us into our third module now. As we move into module 3, I'll pass you back to Lois who'll get us started on that.
Thank you, Fiona. Yes, here we are moving on to module 3, which is called Implement. This is the backbone of effective disclosure and really looks at processes and practices a bit more. So we're looking, we've talked about what you need to disclose, and now we're thinking more about how it is done in terms of processes, practices, and so on. So this has 3 sections, this module. The first is about identifying sustainability related risks and opportunities and how it's done. The second is about the different evaluation processes you might have, focusing on scenario analysis. And thirdly, integration, and that is how you integrate sustainability related processes into your existing suite of practices and processes. Let's start with identifying sustainability related risks and opportunities. Well, remember that IFRS S1 asks companies to provide material information on all sustainability related risks and opportunities that could reasonably be expected to affect a company's prospects, and S2 sets out the requirements for climate-related disclosures. But what about risks and opportunities beyond climate? Well, here S1 directs companies to sources of guidance that can support the identification of risks and opportunities and the information to report about them. So firstly, when identifying which sustainability risks and opportunities to report on beyond climate, S1 says that consideration must be given to the SASB standards, and you can see those linked on the ISSB website. And these are the standards that give us industry and sector specific sources of guidance, practice, and materials that help each sector determine which risks and opportunities are most likely to apply to their industry. After a company has considered SASB standards, they may then also consider IFRS educational material on sustainability related risks and opportunities and the disclosure of material information, and that contains lots of great guidance and examples. They can consider the CDSB framework application guidance, which covers a range of subjects, including biodiversity and social matters. They can look at industry practice, perhaps published by the industry body to which they belong, and the materials of other investor-focused standard setters like the Integrated Reporting Council. So once you have looked at these different sources of guidance to consider which risks and opportunities you should be reporting on, you then can use the same sources of guidance to determine what information to disclose about them. But also you could look at the GRI standards and the European reporting standards. So we saw this, didn't we, in the example from CLP where they reported on waste management that they had referred to SASB and GRI as the means of identifying the risk and determining what information to report about it. Let's look at an example now of IALA, and this is how they explain their process for identifying risks. Now, the first thing they do, the overall concept, is that they communicate and consult on the different types of risks and action plans and management processes that they are aware of. So this is a wide consultation exercise. Having done that, the first step they then take is to establish the context within which the risks and opportunities arise. So they look at internal and external factors for determining which risks and opportunities apply to them. Secondly, they assess those risks by analysis and evaluation and a method of prioritizing risks. And this helps them to understand their risk universe, how they define things in their risk dictionary, and how it might affect their portfolio. And the enterprise risk management team looks after that step. Thirdly, they decide how to treat the risk, what actions they're going to put in place, and finally, how they will monitor and check and review the risk. So that is the process used by IALA, which is a Philippines-based conglomerate, huge organization. Secondly, let's look at an example of a process used by a company called Nest. This is a company based in Finland that's a leading producer of sustainable aviation fuel, renewable diesel, and feedstock solutions for the chemical industry. Now, in this case, Nest has used scenarios to inform their understanding of risks and opportunities. The company identifies risks and opportunities in two main scenarios over a time horizon till 2050. The two time horizons are net zero world, which in which they anticipate that there will be temperature rise maybe of up to 1.5 degrees, and that action will be quite fast. And the other one is called compromised climate targets, where climate action is slow and global warming of 2.5 to 3 degrees is expected. Now, the net zero world scenario is split between global and the EU and North America, and that's only because the transition is expected to take place at different paces and in different ways in different jurisdictions. But broadly, what we see here is that the company has explained their opportunities and risks in each of these scenarios. On a global basis, the company anticipates that in the net zero world, there'll be a growing demand for renewable and circular solutions, so that opportunities will be accelerated. In the compromised climate scenario, the risk is that the demand for their products might be constrained. Now, final thing to note about this example is that in each case, they give an indicative final financial impact in each scenario. And you will see that the most positive one is in net zero world 2050. And perhaps you would expect that because they're a provider of sustainable solutions. And if the world is moving towards net zero by 2050 more quickly, then support for their products is more likely. So let's move now to look at some proportionality mechanisms. We've already mentioned this, that because the ISSB recognizes that identifying and reporting on sustainability related risks and opportunities can be complex. They say that when you're applying these requirements, you're only required to use all reasonable and supportable information available at the reporting date without undue cost and effort. But what does this actually mean? It means that the information the company uses for assessing risks and opportunities shall be specific to the company. So not just sort of generic based assessment, but actually specific to the company. And we certainly saw that in the two examples we looked at. That it takes account of the external environment. We saw that was one of the steps in the process that IALA used. That it takes account of past events and current conditions. Of course, these will be known to the company, but also takes account of forecasts. And perhaps that's what Nest was getting at when they were using scenarios to inform their understanding of risk and opportunity. And in some cases, what is reasonable and supportable will be specified in sustainability disclosure standards set by the ISSB. Right, we're handing over to Fiona now for the next part of this implement module.
Brilliant. Thanks for that, Lois. So once in that area we've identified those risks and opportunities, the next step that companies will need to do is to evaluate the financial effects of them. So this can often be one of the most daunting areas to get started with, we know. So we're going to try to have a look at some of the key concepts here to help you get going with this topic. So S2 is requiring companies to disclose information about the implications of climate change on its strategy and business model. And this is really aimed at helping investors to understand how resilient a company is to climate risks and how it's transitioning to capitalize on opportunities as well. And it also asks for companies' financial and operational capacity to adjust or adapt over the short, medium, and long term. For example, you might want to test your company's resilience to a new regulation to limit certain high emissions activities, or perhaps its ability to respond to changing crop yields due to more frequent extreme weather events. And so to do this, you're going to use scenarios based on science and analyze how those climate scenarios will lead to effects for the company. And it's important to remember when we're talking about scenario analysis that it doesn't require you to predict the future. It's not a forecast, but it's just a tool to test your resilience against plausible possible future events. And so S2 doesn't specify which scenarios a company should use in this analysis, because that's really going to be specific to the company's industry, the time horizons, the risk types, its geographies, etc., that it wants to assess. But S2 does ask that companies use relevant scenarios, and they provide information about which scenarios that it's selected, the relevant assumptions that have been used in the analysis, and the results of the assessments. It also includes guidance for companies on how to determine this approach, which can really start from a range of practices. So you might start with more qualitative scenario and narratives and maybe progress towards more complex statistical methods over time. And overall, companies are asked to use an approach that's commensurate with the circumstances of the company and that uses all reasonable and supportable information that's available at the reporting date without undue cost or effort. So let's have a look at an example again here. So you're probably familiar with Nestle, who this example is coming from, which is the Swiss food and drinks company. And this example is just one output from their climate scenario analysis, which shows a projection of the potential impact of changing climate conditions on the yields of key agricultural commodities that it sources globally. So you can see that in some areas it's expecting decreased yields, some areas it might even see increases in yields, but overall, I think more areas expecting to see a decrease. So what they then go on to talk about in their disclosure is obviously that the potential volatility of yields could affect their supply chain reliability, it could increase costs, and ultimately affect their revenues. And so in their disclosure alongside this, they go to talk about some of the implications of this for their business model and the steps that they're then taking to try and respond to this through product innovation, research and development, and looking at efficiency as well. And we do know, of course, that when we're talking about anticipating the materiality of possible future events, this can be very challenging. So to help us with this determination, IFRS S1 asks that you consider a number of different issues and you continue to evaluate and disclose transparently any uncertainties that you might have. So here is a list of things that companies should consider to inform that assessment. So, for example, thinking about both low probability and high impact outcomes, and thinking about different risks both individually and in aggregate as well. And so, overall, what a company is asked to do here is each reporting period to continue to assess those uncertainties. So, you don't necessarily need to repeat a scenario analysis each year, but rather to continue to evaluate the uncertainties associated with it so that you can incorporate those into the company's strategic planning. Okay, so that's those aspects. And now back to Lois for the final segment of this module.
Thank you, Fiona. So now we're going to look at whether and how you might need to develop or adapt processes to take account of the ISSB requirements, how you integrate them. So as you might remember from the content section in the Align unit, disclosures should include a description of how your climate or sustainability related risk management practices are integrated into your holistic risk management process. However, it's often an area where we get a lot of questions. So let's review again this point about integration of sustainability related considerations into your existing processes. So the sorts of things that you might want to consider are, and some of you have mentioned this in Menti already, when you're looking at your existing systems and processes, how about a gap analysis to check whether there are gaps in existing processes and systems that don't enable you to get the information you need for ISSB disclosures. You need to look at how suitable the processes are, including your prioritization criteria. Now, this is because sustainability risks and opportunities have different characteristics to other risks and opportunities. They manifest over longer and more uncertain time horizons, and the way in, the pace of the transition, for example, is uncertain. Therefore, you need to think about, are the processes suitable for sustainability? Do we need to add more prioritization criteria beyond likelihood and impact to cover things like vulnerability and speed of onset? Are the existing internal control systems suitable for sustainability related disclosures, and how might they need to be adapted? What contributors do you need in the organization to contribute towards the sustainability disclosure? Which departments would be involved? Is this risk management, HR, health and safety, etc.? Who has the expertise and the processes that can contribute usefully? And what are the interconnections between different internal and external factors that inform how your processes need to operate to cater for sustainability disclosure? What uncertainties might you encounter? And from a process point of view, how will you deal with those uncertainties? And what resources do you have in place or do you need to request in order to adapt or develop new systems? Do you need to go through a budget approval or change management process, for example? Now, in your homework, we have suggested that you consider developing a disclosure plan. Now, this is something that's a standalone strategy or part of a wider strategy to help you manage the questions that we just went through and your disclosure plan. It helps a company take control of its own narrative by really focusing on what's going on in your company, because that's what the standards ask you about, your strategy. It supports internal collaboration across different teams, internally and externally. And most importantly, it creates a reference point and an audit trail showing, for example, what are the company's reporting goals and objectives? How are they going to be managed? Which audience does the company want to communicate with? Who is going to be involved? Company secretarial, procurement, finance. How will those departments be organized? What will be their responsibilities? How will data be sourced? How will it be assured, if at all? Importantly, which are the sign-off processes? What are the timing for them? And how and when judgments have been made. So that's why we recommend to you a disclosure plan, because it helps record and keep a record of all of these important points. Let's have a look now at an example. This is from Novo Nordisk, which is a Danish pharmaceutical company. And what they're outlining here is the basis for the preparation of their sustainability statement. So they start off by describing which general reporting standards and principles they have used to prepare their report. And you'll see that it's quite a long list. It includes laws, the Danish Financial Statement Act, and EU legislation. But also they've used the Greenhouse Gas Protocol, the Science Based Targets Initiative, the TCFD recommendations, the GRI, and many, many others. So we know which standards and principles they've used. They then tell us the time horizons they've considered for the preparation of sustainability information, and they actually define what they mean by short term, which is 1 year, medium term 1 to 5 years, and long term more than 5 years. There's a lot more information in here, including how and why estimates have been used, where to find information about assumptions and uncertainties, and other information about the basis on which the statement has been prepared. So you can imagine that doing this in advance of starting your reporting year is going to be very helpful. And again, that's why we recommend it as your homework to have a disclosure plan. So let's do a Zoom poll now, and this is a short one. Is a disclosure plan required by the IFRS Sustainability Disclosure Standards? You can only answer one, either yes, and you must disclose your plan, or no, but it's a very helpful tool. Right, because time's ticking away. Let's share the results here. You can see that you're really evenly split, and I can understand why, but the correct answer is no. There is nothing in the IFRS Sustainability Disclosure Standards that says you must have a disclosure plan and you must disclose information about it. We've recommended it because we think it's a very helpful tool. However, bear in mind that there are some specific requirements that say you must disclose the method that you've used for calculating various things. There are requirements that specifically tell you that you need to describe the basis of preparation for certain things, but there's no requirement to have a holistic disclosure plan. We just think it will help you, and I hope it does. So one more Zoom poll now. What can a disclosure plan help a company to do? To take control of its narrative, so it tells its story, to support collaboration across the company and with external experts, to act as a reference point and audit trail for disclosure, or to skip full disclosure as prescribed by the ISSB. And we're nearly at the end of module 3 now. I can see you know the answer to this, so I'm going to share the results that you've rightly given us. Yes, it's all of the first 3, and of course it cannot be used as an excuse to skip full disclosure. So well done, all of you, that's absolutely correct. And let's hand over to Fiona now for a module 3 summary.
Great. Thanks, Lois. So as you said, we're at the end of module 3 of 4 now, everyone. So well done for sticking with us. We know we've covered a lot, but you're getting into the final stretches of the training. So good job. And we'll keep going into our next module shortly. But before I do that, we'll just remind ourselves of a few of the key things that we covered here. So firstly, we'll come back to those connections. So in the last module, we wrapped up by highlighting the importance of connection between the 4 core content areas of disclosure. And then in this module, we really learned that there are many connections as well between a company and its external and internal environment. And that's really what we need to focus on when we're identifying these risks and opportunities. The second thing we talked about here was evaluating risks and opportunities, and a key component of that evaluation being consistency in your assumptions. So it's important to ensure you're keeping track of any assumptions you make in your scenario analysis and that you are disclosing transparently what those assumptions are. And finally, as we've seen, even if some of this data might not be information you're already disclosing, it could well be that you're collecting it for different reasons, or you have processes that perhaps you could adapt to allow you to obtain it. So, as much as we can, aiming to use those processes and not start from scratch is the ambition here. And so, with that in mind, that moves us into our reflection question for this segment. So, we talked about some of those gaps already in our last module and identifying the gaps. And now let's have a little bit of think about how we might go about addressing them. So, what we want to reflect on in this question is, do we have existing systems or processes that could allow us to collect data that we need to address gaps in our disclosures? So let's have a think again about maybe any existing data sources we know we could use, any processes we might be able to adapt to integrate this information. And hopefully, between us, we can come up with a few ideas that will help everyone think about where to go to get the information that you might need, or what processes you might be able to use to obtain information if you don't already have it. So we won't take too long on this, but we'll just take a minute or two to reflect. So I see we've got a blank screen at the moment, but feel free to share anything that you might be thinking of. Maybe to get us started for inspiration. For example, we might want to think about our existing enterprise risk process because as much as we can, integrating and embedding the assessment, identification, management of these sustainability related issues into our wider ERM process is going to be a good approach to ensure that these risks are embedded, they're assessed in a consistent way, and really driven through in our strategic approach. So, our enterprise risk management process is one example. Thanks for those who've shared some answers there. I see some responses coming in. So, let's have a look. So we have maybe using data mapping and reporting softwares, using the standards to look at how similar companies doing it. So I think that's a good suggestion indeed. Thinking about integrating into existing risk framework. Yeah, exactly. Maybe, as you say, you have operational data platforms that you could use. So you might already be collecting operational data that would be valuable for these assessments, but as you say, you could also adapt what software you're already using to help you capture new information. Someone's mentioned here that finance teams might already be tracking resource consumption costs. Yeah, exactly. So you might be looking at that from a finance perspective, but that information indeed could very well be used for environmental or social purposes as well. So I think that's a really good point. Someone's mentioning maybe you have environmental data reporting platforms. So you might already need to report environmental information on a regulatory basis for permitting for your assets, for example. So trying to obtain those records of what you're already collating on environment at a kind of corporate level would be very helpful. So using software systems, many have mentioned. So there's a lot of different tools out there that you can use exactly that will both give you some structure to how you collect this information, have a bit of a workflow around collecting sources and checking data, but also it might give you some inspiration about what you should be recording as well and how to obtain that. Someone's mentioning supplier relationship management. Yes, exactly. When we're talking about our upstream value chain, actually, a lot of what we obtain from our suppliers through maybe qualification questionnaires, ongoing due diligence may be very useful to inform that understanding. Um, Great. Lots of really good ideas there. Thanks, everyone. So, I think you've already highlighted lots of really good things to think about here, and hopefully, good inspiration for us all to realize that actually there's probably a lot of sources that we already have that we can make use of here. So, a good next step here, maybe just mapping this out in your organization, understanding what you already know that you have, maybe what you can get hold of, and then maybe prioritizing areas to get in place that maybe you need to kind of adapt or integrate this into. Great, thanks everyone. Okay, so we'll move back to the slides now, and we're going to be getting started on our fourth and final module, Communicate, which I'll hand over to Rebecca for.
Thanks, Fiona. Just waiting for control. I think I've got it now. Okay, perfect. Hey everyone, good afternoon. So yes, I'm going to walk you through or talk you through our last module. So congrats on getting through to this point. So module 4 covers the communication element of reporting. So communicating with investors, really focusing on the what, where, and how. So as with the last unit, we'll cover this in 3 main sections. We're going to talk about location, so where disclosure should appear. And I know there's been a few questions in the Q&A on this, so we're going to kick off the conversation on this part. Okay, so before getting into the specifics of the requirements, it's maybe helpful to think about the sustainability disclosures in the context of a complete reporting package that's useful to investors. And as previously mentioned, the requirements in the ISSB standards are based on addressing the information needs of investors and effectively to build on past standards and frameworks such as TCFD, SASB, and GRI complementary, which we've discussed to date. So one of the major advancements that the ISSB standards bring is really the rigor of accounting and the focus on connectivity to the financial statements. And so while the ISSB and GRI standards do share some content requirements, what information to report on that is, they really do differ in terms of the overall objectives. So as you've heard a number of times today, the ISSB standards are really focused on investor information needs and decision making. So that is information about sustainability related risks and opportunities that could reasonably be expected to affect a company's cash flow, access to finance, or cost of capital. In comparison, as you'll see here, the multi-stakeholder focus of the GRI standards, they really take a bit of a different approach, and this is more related to kind of that, what is the target of your disclosures, and you're trying to satisfy different information needs than those of investors. So they take a different, albeit complementary approach. So in practice, GRI approach is commonly understood more, I would say, among sustainability practitioners, whereas the IFRS approach is likely more familiar with the accounting professionals and finance executives. So really, in summary, many of the impacts traditionally identified as material in the GRI standards may give rise to sustainability-related risks and opportunities that are likely to affect a company's prospects, and therefore investors would need information about them. And you can also find some additional information in the slides that talk about the potential areas of focus for primary users. Okay, so what is material information? Everyone's favorite topic, right? So you probably come across references to different types of materiality based on different reporting standards and frameworks. So it's maybe helpful just to recap here what we mean at the foundation about material information when it comes to the ISSB standards. So as we discussed in the first module, information is material when it influences decisions of primary users of general purpose financial reports. So in other words, investors. It informs decisions about things like whether or not to provide resources to a particular company, buying, selling, or holding equity or debt instruments, granting loans or other form of credits, as well as voting on or influencing how management uses a company's economic resources. And in this context, when preparing disclosures, the key consideration here is really the characteristic of the investors and the company's own circumstances. So what do I mean by that? Well, for example, different investors can have different and sometimes conflicting information needs, and therefore the intent of sustainability-related financial disclosures under the ISSB standards is really about meeting the common information needs of investors. And this is really about the key information that your average investor would be looking for. The important thing to remember is that materiality is a characteristic of information, and the ISSB standards take a two-level approach to this. First, in the identification of sustainability-related risks and opportunities. That's based on what would investors expect to affect a company's prospects. And then the next level is about what material information about those risks and opportunities investors would need in order to make decisions. Okay, moving on to disclosing information under the ISSB standards. So IFRS S1 requires that material information be clearly identifiable and that the information itself is clear and concise. And what this really means in practice is that material information shouldn't be obscured by other non-material information. For example, by information that a company discloses on the basis of, say, another reporting framework that's not centered on the information needs of investors, but maybe focuses on broader stakeholders. And why is this important? Well, first, the location of sustainability-related financial information within general purpose financial reports might vary between companies across different jurisdictions, and also the information designed to meet the needs of other stakeholders who might have it all kind of in a bundle together, which might be provided voluntarily to meet other regulatory or by law in terms of other regulatory requirements. And another potential problem here is that material information reported under ISSB standards might be obscured by that other information because it might be buried amongst a whole host of information that's been prepared for different purposes and according to different objectives. And this could be problematic in cases, for example, where reports are perhaps poorly organized in terms of content, and therefore material information is scattered throughout. And again, this is important because a company won't be able to assert compliance, which we'll talk about in a little bit, with the ISSB standards if a report is overloaded with irrelevant data or if it blends information for different audiences without clearly identifying the information that is material again to investors. And I can see there's a link there that's just popped up in the chat. So as you see here on the slide, there is additional material that the Foundation has published that can help you with this. Okay, so now we're going to run a quick poll and hopefully I know how to do it. Fiona, you'll help me with it. Okay, so quick poll. So information should be disclosed in the annual report when applying ISSB standards if we can select all that apply. Omitting that information could reasonably be expected to influence investors' decisions. B, it could reasonably be expected to affect the company's cash flows. Or C, it exemplifies the values of the leadership team. So we'll give you a few seconds to consider this. We're aiming for 50% people. I'm not actually seeing any results pop up. There we go. Okay, I see. So we've got 89% of you saying omitting that information could reasonably be expected to influence investors' decision. That's true. It could reasonably be expected to affect an entity's cash flow. Absolutely. And then it exemplifies values of leadership team 30%. So actually C is not correct. And there's a nuance there maybe, but unless it's been determined that a particular value being exemplified are expected to have a financial effect on the company, then this information may not actually be necessary. Thanks for bearing with me. Okay, so now we're going to move on to where to report. So returning to location and where to report disclosures. Again, we've had a number of questions about this. So really the standards must be, so information disclosed under the standards must be made available at the same time and on the same terms as the financial statements. So that is as part of the same general purpose financial reporting package. That said, IFRS S1 does not have requirements that specify the exact placement of that information. And this just means the ISSB standards don't specify where within that overall reporting package the information has to be provided. And this is really by design in order to give some flexibility and accommodate jurisdiction-specific requirements on location of reporting. The most important factor really to consider here is to ensure that sustainability disclosures are for the same reporting entity as the financial statements. And again, that they're disclosed at the same time as the financial statements, covering the same reporting period. And it's worth noting that the standalone sustainability reports, they're not prohibited by the ISSB standards. I know we've had a few questions about this. Again, that is allowed so long as they're provided, whatever is provided, that form, is part of that general purpose financial reporting package. Also, there's some requirements around cross-referencing. So cross-reference information must be available on the same terms and at the same time as the sustainability-related financial disclosures. And really the complete set of those disclosures cannot be made less understandable by including information by cross-reference. Importantly, cross-reference information also becomes part of the complete set of disclosures made under ISSB. And as such, they must comply with all of the ISSB requirements, including things like being relevant, comparable, verifiable, etc. So to get a better idea of what this looks like in practice, I believe I'm going to pass on along to Lois, who's going to run through an example.
Yeah, thank you, Rebecca. And rather than give a single example here, we're just providing you with an overview of current practices on where companies are reporting information. And this graph draws on work from the World Business Council for Sustainability Development, and in particular, their 2025 Reporting Matters, which is an annual review of corporate reporting from their membership, a selection of global companies. So these are companies based all over the world, and it's just a snapshot of where they report information. So you can see that at the top, there are percentages showing stand-alone report production on sustainability information from 2023 to 2025. And you can see that the incidence of standalone reporting is decreasing. So it was 62% in 2023 and is now 54% in 2025. And this perhaps reflects the shift towards reporting financial and non-financial information within the same document, possibly in line with mandatory requirements in different jurisdictions. So that would explain the trend over time in the reduction in standalone reporting globally. Of course, this picture is different when we look at different regions. So you can see that standalone sustainability reports do still predominate in the Americas, representing about 81% of reports. In APAC, there's a bit less, 58%, and EMEA, 39%. Now, this diagram also shows us the incidence of combined reports, those that combine financial and non-financial disclosures, such as in annual reports with financial statements or in universal registration documents, or integrated reports, which are probably following the prescriptions of the integrated reporting framework. So a little analysis of different trends, but overall the trend is for standalone reports to be less popular now globally. So back to you, Rebecca, for digital reporting.
Digital reporting, exciting. Great. So we're going to briefly talk about the evolution of digital reporting, and in this context about the ISSB taxonomy that you may have heard about. So in general, the term taxonomy is really just a general word for a classification system, and oftentimes companies will use their own internal taxonomies that essentially help to define key terms across different businesses and functions. And when you may come across this reference to taxonomy quite a bit in the context of a sustainable finance taxonomy, such as the EU taxonomy, but also a growing number of countries that are also developing their own green taxonomies and are usually components of a broader sustainable finance framework. So that said, in that context, sustainability taxonomies essentially help to classify different types of economic activity as either sustainable, not sustainable. There's a range there. Now, in comparison, for ISSB taxonomy, we're not talking about that. What we're actually referring to is something a bit different. So it's still a type of classification system, but it refers to one that's a way to categorize information within a report. So in this world of AI and the push for digitization, you've probably seen a shift or a transition away from traditional PDF formats and increasingly towards information on web pages and contained within structured data sets, such as databases that are offered by stock exchanges or regulators. So recognizing this shift to digital, the IFRS Foundation has developed the ISSB taxonomy, which is essentially a machine-readable digital tagging system. This was published back in April 2024. And the overall intent is really to help investors analyze sustainability reports and information. How does it do this? Essentially, it's translating the requirements of IFRS S1 and S2 into standardized data tags, which then facilitates digital reporting and makes it easier for investors and data platforms alike to take large data sets, say for an entire industry, for example, and then bring them together for analysis. So it is worth noting the ISSB taxonomy is not mandatory for compliance with the ISSB standards themselves, but rather the taxonomy is, like I said, is designed to support the digital submission of ISSB disclosures, which, as I alluded to, comes with a few benefits. These include things like using the analysis. It's just a lot easier to structure a lot of data in a similar way, to analyze it across businesses, sectors, geographies. Also, tagging information can help facilitate automated checks for quality and consistency. And also, digital tags can have labels and descriptions in multiple languages. So that really greatly enhances the accessibility of information, being able to access the same information in multiple languages. Okay. So, following the discussion on location and timing, we want to spend a bit of time talking about efficiency. And we've actually added this to the training because we often hear from companies that they face a growing report burden. And what we hope to highlight is that when applying the ISSB standards correctly, there are in fact a number of efficiencies that you can gain to help reduce this burden. Okay. So what does effective communication actually mean, and what does it look like? Well, often companies think that if they put all of their information that they have into a report, they're covered. Everyone's happy. However, when you think about the ISSB standards, remember that a core conceptual foundation, which Robert covered at the start, in S1 is around fair presentation. And what this means is that a complete set of sustainability-related financial disclosures under ISSB should present fairly all sustainable risks and opportunities that could reasonably be expected to affect an entity's prospects. So it's not about putting everything into a about sustainability into a report or part of a report. It's more about presenting material information. So information that's complete, neutral, and provides an accurate depiction of the risks and opportunities that companies face. IFRS S1 also requires information to be clear and concise or succinct, as you see on the slide. And the clearest form that a disclosure can take will obviously depend on the nature of information. So this might include, for example, the use of tables, graphs, or even diagrams with accompanying text, if that is the clearest way to convey a meaning. And in terms of being concise, this really means that companies should avoid duplication, unnecessary duplication, use clear language, and avoid boilerplate information. Okay, so we'll spend a few minutes talking about the quality of information to report and how. And traditionally, the disclosure of sustainability information and financial information has been different in that regard. Now, accountants in the audience are probably fairly familiar with the rigor that's required when it comes to data collection, oversight, sign-off, and even external assurance that's associated with preparation of financial statements and disclosure of general purpose financial reports. And this whole concept of a very strong internal control environment is really well understood in that environment. In comparison, sustainability information has not traditionally been prepared under the same type of control environment. And because of this, the ISSB standards really do focus on elements of quality in the information that's disclosed. So how is this element of quality brought through in the standards? One example is the requirements related to providing comparative information from previous reporting periods, except during the first year, which is part of a transition relief that we'll cover later. As well as requirements that deal with things like restatements and the need to restate comparative information or amounts for prior periods disclosed in the case of a material error. Again, focusing on quality, companies should also avoid unnecessary duplication and can achieve this through the use of cross-referencing, which we mentioned earlier. And also, as we've discussed a number of times, materiality. So whereby the ISSB standards require disclosure of material information, and the companies can provide connected information, including highlighting connections between risks and opportunities, between the core content areas that we've discussed today, and of course, between sustainability-related financial information and the financial statements. And last but not least, talking about aggregation. So when aggregating information should be aggregated if it has shared characteristics and disaggregated if not. And this is really about ensuring material information is not obscured, such that information shouldn't be aggregated if doing so would obscure material information. Moving on to cross-referencing. So you may have noticed that there appears to be some overlap in the topics covered and the information disclosed around different reports or sections of the report. So what Lois was mentioning around risk management being fairly similar to governance across both standards. So in fact, IFRS S1 actually requires companies to avoid unnecessary duplication. So for example, as Lois mentioned earlier, if a company has the same governance approach for all sustainability issues, then this information would only need to be disclosed once. So if climate is part of that overall process, you would only disclose that once. Equally, information required by ISSB standards, maybe it's in another report that a company publishes. So for example, in the related financial statements, then the company can include material information in its ISSB disclosures by cross-reference. But as we discussed earlier on, cross-referencing is only allowed provided the other report for where you're sourcing that information is available on the same terms and at the same time. So to help make sense of this in real life, I realize it can be a bit confusing. Lois, you're going to run us through an example.
Yeah, thanks, Rebecca. This is just a really quick example from ArcelorMittal about how they do their cross-referencing. In the first column, you'll see content elements you're now familiar with, for example, on governance, risk and opportunities, basis of preparation. And in the second column, you can just see a reference to where information about these content elements are, and sometimes the reference is to the same report, so within the sustainability report, and sometimes we're being referred, for example, in the case of strategy and resource allocation, to the annual report and the 20F. So a simple example of cross-referencing. Over to you again, Rebecca.
Thanks. So we're going to talk a bit about mechanisms that support adoption. So Lois touched on this previously in terms of proportionality mechanisms in the last section. So I won't go into too much detail here, but really we just wanted to highlight the fact that there are mechanisms within the standards that are really meant to support preparers, companies get started with ISSB standards and also recognize that there's varying degrees of maturity out there when it comes to sustainability reporting. So what do these mechanisms look like? So one simple thing that has been put in place is the adoption of well-known terminology and concepts familiar to companies. So boring language, for example, from the IASB and the accounting world. Also, many requirements in S1 and S2 are to be applied proportionally, which again recognizes that companies will have a range of capabilities and preparedness on these issues. So for example, qualitative scenario analysis is permitted. We had a question about that in the Q&A. And you'll also see the phrase all reasonable and supportable information as at the reporting date without undue cost or effort. Or you'll also see commensurate with skills and capabilities and resources. So those are in a number of places. There's also, the standards also specify certain transition reliefs that companies can make use of in their first year of reporting under ISSB. So one of those include, as you see here, climate first. So that's, you can limit your disclosures to climate in the first year that you apply ISSB standards. And then in subsequent years of reporting, you would then disclose the other sustainability related risks and opportunities. Another relief is that companies are able to provide annual sustainability financial disclosures with their next half-year reporting rather than at the same time as the financial statements. And there are also reliefs that relate to Scope 3 GHG emissions, as well as the application of the GHG protocol corporate standard to measure emissions. So if you're already using a different measurement approach, you're able to use that for a specified amount of time. Another relief allows companies to include GHG information attained from companies in the value chain that might have a different reporting cycle. So depending on your year end, you might get information from suppliers that's a bit different, but so long as it covers the same amount of time, you can use that. And again, we've mentioned a number of resources and guidances that you can use that support that implementation in a proportionate way. So for example, the SASB standards. Okay, due to time, we're actually going to skip through this poll, but we will move on to the last section. So finally, the section of the last unit covers, looks at how to ensure that users of financial reports have confidence in the information that you're disclosing. And this is especially important being as trust is such an essential component of disclosures and increasingly so with growing concerns over things like greenwashing. Okay, so what's a good trust builder in information when you're reporting? So what that really relates to is showing data and trends over time. So how you're telling your story to investors. And as such, IFRS S1 requires that companies disclose comparative information for the preceding period for all amounts disclosed. And this also relates to qualitative or narrative information if deemed useful for investors. And why is comparative information so important? Really, this just helps to emphasize the context, and it also allows companies to demonstrate relative progress over time and also communicate changes or evolution that a company might make to its strategy or risk management processes. Also, metrics disclosed by a company might be redefined or replaced over time, or a company might change its methodology for how it's estimating a particular metric. And in these situations, it's important that a company revises the comparatives so that investors can compare and analyze the current periods with the relevant prior periods. Another example is that a company might have new information compared to the prior years, for example. Say a company obtains actual GHG emissions data from its supply chain that it had only previously estimated. Then the company will need to revise that information if it deems it material. Occasionally, a company's sustainability disclosures may contain material errors, and in this situation, a company is required to restate these errors in the comparatives provided. And just to note, revisions or restatements are only necessary when there's a risk of material information being omitted, misstated, or obscured because of not revising or restating the comparatives. Okay. So finally, it's also important to build confidence by providing a clear statement of compliance with the disclosures and requirements under ISSB. So in fact, a company that complies with all of the requirements that we've been talking about today is required to make an explicit statement of compliance. And it's important to emphasize that a company can still make this statement if it's decided to make use of specific transition reliefs that we discussed in that first year of reporting, or if the company is using any of the proportionality mechanisms. So that doesn't detract from being able to make a statement of compliance. There are, as there always are in this world, some exceptions to this. So where information required could be omitted, and the company would still be allowed to make a statement of compliance. And these two exceptions relate to commercially sensitive information, and when law or regulation prohibits the disclosures of something that the ISSB standards require. So for commercial sensitive information, what this essentially means is that a company does not have to disclose information about a sustainability-related opportunity if the information is deemed to be commercially sensitive. So, for example, the company is planning an acquisition. It doesn't want its competitors to know about it. In this case, the ISSB standards provide a relief and allow a company to omit that information, provided that certain conditions are met. And you'll note that I emphasized opportunity because this exception only applies to opportunities. It does not apply to sustainability-related risks. So there are additional handouts, as you can see on the screen there, on the voluntary application as well, that can help give a bit more information about this. The second exception is if a company is prohibited by law or regulation from disclosing certain information that is required under ISSB. So in this case, disclosures can be omitted and a company can still make a declaration or a statement of compliance. It's also important to note that companies that are beginning to phase in the ISSB standards voluntarily and are therefore maybe only partially aligning to what the standards require, these companies would not be able to make an explicit statement of compliance. And instead, what we typically see is that companies will disclose an explanation detailing where they are on the disclosure journey and outline what measures they're taking to enable future compliance. And again, you can find more information about this on the links in your handout. All right, I'll pass back to you, Fiona. I believe we're at time.
Great. Thank you so much for that, Rebecca. Indeed, I know we're just into our final minutes now, so we'll be wrapping up the session. So we'll just leave you with this slide that's available in the handout of a few handy things to remember from this segment. So thanks, Rebecca, for talking us through all of those points. So just to wrap up this module, we really talked here about a few key things. So firstly, where to report your information and being really clear on that primary user here of the investor audience to guide your approach. We then talked about efficiency, and I think our key takeaway here is that less is more. The objective is to try and be concise and focus on that material information to guide our approach. And finally, we talked about report user confidence, and Rebecca talked us through some various practices and approaches that we can keep in mind to prepare our reports and ensure that there is that confidence in the disclosures we're providing. Okay, so for time, we'll skip our last activity there, but we just have a final question available to you in Menti, which I'll leave you to respond to in the background if that's okay, whilst I just wrap up on our final slides. And that question is just to reflect on how comfortable you feel now about the different activities that we were aiming to advance with you in our training today. So that was around explaining to your colleagues what the ISSB is, on using the standards, and on developing a strategy. So if you can vote in Menti and let us know how you feel about this now, that's really helpful for us just to get a sense of where your understanding is at. I see the responses that have come in so far as showing three point something on the scale compared to 2 before we started. So I think that's great to see a little bit of an improvement there. So thanks, everyone. So just to mention a few final things in wrap up. So this is the end of our live training together, but as a reminder, to help you take this forward, you can use that homework assignment to develop your draft disclosure plan. As we said, this is an optional activity. There's no need to do this and complete it and send it to us in any way, but it's structured around the same activities we've used in our exercises today. So hopefully it can help you to put into practice what we've talked about in your companies. And a few more resources just to highlight that can help you there. So, firstly, we've mentioned a number of times the IFRS Knowledge Hub that's available to you. So, that's the go-to place to find all of the different resources prepared by the IFRS Foundation that we've used in our training today. We'd also highlight there as well that there are 4 free e-learning modules available to support adoption of the ISSB standards. So, these are self-paced courses, and CPD credits are also available for those. I'll also just mention very quickly a few different routes that you can use to further your relationship with the IFRS Foundation, which are highlighted on the slide here, including undertaking the FSA credential and joining the IFRS Sustainability Alliance. And finally, to highlight the IFRS Foundation's conference is coming up at the end of June, which you can register to join both in person and online. So I think the team will be able to share the link with that to you, but I encourage you to look into that if you're interested to know more about that event. So from the other organisations involved in this training, just a few key things to mention. We've got our colleagues at the IFC who support this training, who have a Beyond the Balance Sheet toolkit of great resources. So encourage you to check that out. We've mentioned already the SSE toolkit as well. So you can find all of the links to these organisations and their resources in this slide presentation available from the event page. But one final point I know we want to make sure that we've had time to mention to you is how to get your completion certificate. So a big thank you for taking part today and for all of your participation. To get your certificate, you need to fill out the feedback survey. So Lois will just share the link to that in the chat with you now. So if you access that survey via the link and fill that out, you'll get sent your certificate in around 1 week's time. You can also wait, you'll get an email from Zoom 24 hours from now, which will reshare that survey link again. So don't worry if you miss it in the link in the chat, you'll get that again, but it's available there in the chat for you now to get your certificate and fill out the form. And as we close out, I just want to say a few final thank yous. Firstly, to the SSE supporters who support our work and make these programs possible. And in particular, thank you, of course, to our hosts today, the Muscat Stock Exchange, for coordinating and hosting today's session with us. I'd also like to thank our partners at IFC and the IFRS Foundation, particularly Robert and Rebecca, for joining us today and sharing all of their expertise with our participants. And of course, a big thank you to all of you who've joined us in the training. It's great to have had your participation in the session, and we wish you all the best with taking forward this work in your organisations. So we'll close our session there. So have a great day, everyone, and thanks again for taking part. All the best.